Rush you again, then I might rush you again, then I might rush you again, then I might rush you again. just gone over half an hour of the show. Once again, this is Selection Radio on Apple Music with myself, Hagen. This is the Hagen Takeover. We're about to step it up one more gear. Here we go. Way. 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 Way.
This is selection.
Way. 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 Way.
Good morning. 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 Good morning. Good morning. Good morning. Ah, here we go. Test, test, test. Can you guys hear me? How y'all feeling this morning? Y'all sure? Y'all still waking up? That's what's happening? If you're awake, clap your hands once. If you're awake, clap your hands twice. If you're still asleep, clap your hands. All right, so I want to give you guys a huge shout out for, again, just coming out and enjoying this year's summit. A lot of work has been put into bringing in some pretty phenomenal speakers. I hope that you guys enjoy yourselves today. I know that you guys are going to be probably checking your phones because, just as a heads up, I'm just guessing, but I'm assuming that T-Triple-Q is up to 102. Somebody fact check me on that one if I'm correct. Okay, well, there it is. All right, so shout outs to also the folks that are tuning in live because they're actually watching this live virtually. So they're kind of like in the room with you right now. So shout outs to you. Welcome for joining us. So we got a lot to like literally get over today. So y'all ready? Okay, so if you're ready, I need to see notepads. Where are they at? Where are they at? Where are they at? Or note-taking devices. Okay, all right. So first things first, we're gonna start this off with a bang. But before I do that, I think I would be remiss if I'm just sitting up here on the stage by myself. So let's give it up for none other than the wonderful Jolene GC in the place. All right. I mean, we upgraded today. Look at us. Ow.
Good morning, y'all.
Yeah, she's looking at the setup. Did we do it right? Did we do it?
Camera.
Camera's right there.
Okay.
Shout outs to Rome in the building. All right, so we got a lot to go over today. So yesterday we started off with a phenomenal experience by one Mr. Anthony Chacon. Capital. I think that he had to hop on the flight back.
Oh my goodness.
Wall Street money never sleeps. So.
That's right. It is still Friday. The market is open.
I know. And then on top of that, we also had his wonderful mentee protege who had an interesting conversation.
Yes.
Yeah.
Yes.
I think here with us today. So shout outs to Gaurav. We appreciate.
Oh, she got a camera that can pan to the back, like boom.
Yeah, right. We'll probably get some like, camera footage of people out in the crowd. May have to make everybody sign waivers. Just kidding. But yeah, so today we're getting started off with Veritas from one Mr. Corey Harris.
Oh, I'm excited. Where's Corey? I see you.
He's here. So like the crazy thing about it is Corey Harris came through last year's summit. And who remembers Corey from last year's summit? Okay, so the folks that were here last year, he brings in a wealth of knowledge. Now, how many of you guys have seen him on the Come Up series though? See, look, we looking for the real ones. If you okay, all right.
Good job.
Yeah, so pretty much he comes from a legal background, but also has a breadth of knowledge as it pertains to startups, investment, international investing, as it pertains to he lives abroad. So I'm probably sure that he can give us a lot of information there. So are we ready to get this day started?
We are. I just want to bring up.
Are there any church announcements today? Or?
Oh, yes. Church announcements. First, we just bow our heads and pray for the sick and the shut-in and the cousins who could not make it for flight delays. Just take a moment. All right. And then I want you all to pray for brother. I'm just kidding. So,
Jerome.
So we have a full day today, and I just want to make note that those of you who are VIP badge holders I think it's at noon. At noon, you will be asked to a separate room And we'll need to check your cell phones at the door.
No, that's tomorrow. That's
tomorrow? I'm sorry.
She already a day.
I'm already jumping to Saturday. Okay, but for Friday, tonight is the VIP mixer, and that's going to be at 6 o'clock.
That's tonight.
And that's on the 4th floor. So those of you that have a VIP badge, you can go upstairs to the 4th floor for the mixer. And then I think that's like the main thing that people need to know that they might not know.
Yep.
Let me make sure that you all have like the schedule for today. Is there anyone who does not know what the schedule is for today? Okay, so we got it. Okay. Tap me on the shoulder and I'm gonna get you guys.
Did you guys just get in today?
Yesterday, I saw them in the elevator. Saw them in the elevator. Okay. Oh, and then one other thing before we get started, I just need to make sure the Instagram name starts with like heavenly. Is that person here who just got in at midnight?
I feel like you just called me out.
No, that's Keisha. No, I'm looking for. Okay.
Oh,
Yes. She made it. She made it. Okay, I just have to make sure. Okay, you made it. Okay, I just have to make sure. Other than that, Mark, I think we can just get this started. Everyone's ready, right?
hey, look, they said that they got notepads and everything else. So
Okay.
you ready to get it popping?
Yes.
Or are you ready?
Ready. He stays ready.
Hey, look, he came out the womb with his shoes laced up. So. For the thousands in attendance. All right, so
but check that virtual can hear everything.
they should be able to hear. We're
Okay.
good on audio.
Good.
So
Look at Rome doing the Lord's work. Okay. All right.
shout outs to Victor as well, Levic,
Okay, Levic.
for
See you over there.
AV getting us right.
All
We
right.
appreciate you and your existence, sir.
Okay, great.
All right,
Let's
so
kick it off.
without further ado, Mr. Corey Harris, give him a round of
Give
applause.
it up. We need some theme music for Corey.
You might have to start bringing in some theme music.
We need
but,
some
you know,
music.
we'll work on it. We'll work
Okay,
on it.
I'm gonna pass this.
He's gonna like literally take the mic. So
Okay, yes.
Testing, testing. All right. Hello, everyone. Hello, everyone. That's more like it. That's more like it. I want to wish everyone good morning. Greetings from Bangkok, Thailand. So I'm a little jet lagged myself. So it's been a long couple of hours, actually series of hours traveling. But what I want to go through today briefly is what I'm going to talk about is invisible pools of capital. And before we get into that, because I did see it, it didn't seem like everyone was familiar with who I am. So I'll give you a quick little rundown. Let's see if we can test this. Let me know which direction I should point this. Okay, so I'll put my little bio up. Okay, so you guys can see that. I won't quote it, but I'll let you read it. But long story short, and it's also on the Come Up series. So Mark and Jolene and I talked about kind of my journey and my background and how I ended up where I am today. So I won't go into that. But what I do every day is help startup founders and CEOs. I also help capital allocators and high net worth individuals. So startup founders is pretty clear. Capital allocators is anyone from, venture capitalists who might be in the audience to folks who may have come into large sums of wealth and they're trying to figure out, what exactly do we do with that? So through this talk, I'll give you some examples of that. And what I wanted to do here today, because I was at the event last night and recognized that we have folks kind of in the startup founders looking to found a business category. We also have people in the category that are from venture capital firms or connected to venture capital firms. And then we may have folks here as well who are kind of thinking about and trying to figure out what to do with pools of capital that they may have. And so at any point throughout this discussion, which I wanted to be interactive, if you think it makes sense, we can do questions during, or Mark, did you want me to hold questions till the end? Kind of whatever's comfortable. Okay, so I'll get through these slides, and then for anyone that wants to double click on something, make sure you keep your question in mind. I'm happy to go through in further detail. So what do we do at Veritas Global? As a law firm, I help startup founders. I work with general partners and limited partners. So for example, if you're a founder and you're trying to raise venture capital, you're talking to people who are referred to as general partners. They're the general partners of the fund that they run. I also work with limited partners. So limited partners would be high net worth individuals or institutions who are investing in said funds. And when I say I help those people, I basically do all sides of those transactions, from structuring the fund for the general partners, the management companies, as well as company side, which would be you as a founder talking with VCs trying to raise capital. So what I'm going to do today is kind of give you all a brief overview of, and also do things that you see here as well. I won't list them all out, but you can read them. So like general counsel work and that sort of thing. But what I'm going to try to give you a peek into that most people never see, and I was actually up adding this in last night for the Come Up series, for the group here, we're going to say family, to kind of give you guys a peek behind how these funds are structured, why they're set up the way they're set up, and some context effectively for you as a founder, or if you're in the VC space, but you may not really understand how your fund was structured and why it's set up the way it's set up. And then I'm also going to do something at the very end on the high net worth family office space and connect things here to Seattle. So if y'all are ready, tell me you're ready. All right, let's go. So invisible flows of capital. And let's start with some context. So I have here some context of 3 individuals. You've got a founder, you've got a fund manager, and you've got a high net worth individual. The founder is pretty straightforward. A fund manager, as we mentioned, this could be venture capital, this could be private equity, this could be hedge funds. This could be anything from investing in the next Google, the next Facebook, to investing in crypto and that sort of thing, because those are all the same structures. And then high net worth could be anything from an NBA player, somebody who inherited a bunch of wealth, or even hit the lottery, that sort of thing. Each of these types of persons are a part of what is basically a capital stack. A capital stack meaning, let's bring it into a founder. If you are a founder, most founders would say, I need to raise X amount of money. That's kind of everybody knows that. You know you need to raise the money, but folks don't necessarily understand the context. And so what I want to do first is kind of break down from a founder's perspective a couple of things that folks should keep in mind here if you're in the room and you are either working on a startup, or you're planning to work with a startup, or even if you're a VC and you're working with startups to kind of help you educate them. So first I'll ask here is, are you pitching the right VC? And what do I mean by that? Well, some VCs invest in crypto, some VCs invest in healthcare tech, some invest in consumer staples, some invest in technology-based startups, some only invest in the United States, some invest globally. So with all these things in mind, that's where that question is prompting. When you're trying to raise funding, you need to understand who is your audience. And so a lot of times what I've observed is folks may have the raw ambition of wanting to understand, look, I need to raise a lot of money, and kind of knocking down a ton of doors and pitching, and you may not be getting anywhere. And one big thing you can do to help yourself is understanding what your particular startup might be and who that target venture capital fund or angel investor group might be. Because as I started off, everyone doesn't invest in everything. And so you can improve your hit rate by just understanding that from the start. Now, next, how big is your TAM? Who in here knows what TAM stands for? If you can raise your hands. Okay, so we have some folks and not others. So I'll just say it for everyone. TAM stands for total addressable market. So in this case, if we're talking specifically about venture capital, we are in Seattle, which is a hub for venture capital, the home of Microsoft and Amazon, et cetera. These were companies, as an example, that started off as founder funded, family and friend funded, and then subsequently venture capital funded. In those conversations, when you go to have a conversation with a venture capitalist or a fund, they are thinking about what is the TAM? And I'll give you an example. If I am starting a global social network that anybody can access on the internet, there are roughly 7.9 billion people on the planet. Of that, about 4 billion have the internet. Therefore, your TAM would be roughly 4 billion people for everyone with a cell phone. Another example, if I'm in a small town or even a larger city, and let's say I'm starting a chicken restaurant, your TAM in that case is going to basically be limited to that town. And that is likely not something, unless you were to go franchise and scale up and become like a McDonald's, That's not something that a venture capitalist is going to be interested in, at least initially. And the reason is their mandates. Venture capitalists are trying to hit global home runs. They're looking at companies that can potentially be IPOs. And really, the secondary benefit would be potentially a merger and acquisition situation, meaning if you can't make an IPO, let's say a Microsoft or an Amazon will buy your startup out. And that's very common as well. But typically when a VC is deciding in a committee, should we invest in X or Y company, they're trying to figure out, is the TAM something that's large enough such that, you know, we can hit a real home run and be the next Facebook, the next Google, the next Coinbase. Now, with that being said, it's important to understand before you even prepare any kind of documentations to talk to VCs, do I fit in one of these two categories? Fortunately, most VCs will be nice and won't necessarily shut the door in your face, but you may not get a response. You may, because from their perspective, they're looking at thousands of pitches a week. And if you're not within their categories, they're just going to be on to the next thing. And so you can do yourself a lot of favor by kind of thinking through and preparing in advance of talking to these type of folks. And the final one I'll say here is learning from rejection. And I'll give you a couple of stories and examples of that. Most people in 2025 have heard of Ethereum. Who in here has heard of Ethereum? Okay, everyone, about a 99% hit rate. So Ethereum was the first blockchain outside of Bitcoin. Back in 2014 or so, Vitalik Buterin was trying to raise money for Ethereum as a venture-backed company. He went to Sand Hill Road down in Silicon Valley. He pitched to every VC he could find. They all said, no, this is crazy, right? And in that example, that actually is what led to what we now know as the ICO boom that happened in 2016, 17, 18, and led to where things are today. But I say that to say is that the rejection part of that process is an inherent part of the startup process. And the best way I would analogize it is just because a VC tells you no does not necessarily mean your vision is bad or your plan or that it won't work. There's often many other things going on. So I'll give you some insight here and some examples. The first example, a typical venture capital fund, let's say a medium to small size fund, it may be anywhere from $5 million to $25 million in size. They're basically playing a game of thinking in bets, which is a book by Annie Duke. I recommend you read it. And I'll be available to talk for some of the things I mentioned that folks may not catch, but it's called Thinking in Bets by Annie Duke. And what the premise of that book is about probabilistic thinking. She was a well-known poker player and statistician and all sorts of things. But what VCs are doing is they are knowing that, let's say we've got a $20 million fund, our max check size is $500,000. They may set aside additional money for follow-on investment, which would mean a second round of investment, a third round, a fourth round, et cetera. But they are trying to spread those bets because they know that depending on the stage they invest in, the companies may not work out. Now, let me double click on the thing on one point right quick here when I say of knowing who you're talking to and learning from rejection. Not every venture capital fund is going to invest in initial ideas. Those are called seed stage ideas. That could be literally you and your buddies or your girlfriends, et cetera, in a basement with an idea on a piece of paper. That is a seed stage idea, meaning the VC is investing basically in you and your ability to execute on your idea. Now, beyond that stage, you may be at a Series A, a Series B, a Series C, et cetera. As you progress on that hamster wheel, the market traction of your idea has changed. By fact of you getting to that next round, it means that you have become more successful in solidifying a product market fit. And the types of investors that are interested in becoming involved in your company change. The angel investors, the friends and family, the Series seed funds that come into your fund at that idea stage, those are not the same people. They don't have the same risk profile as folks who come in when you start generating cash flow, when you start scaling beyond 20 or 30 employees, when you start planning to expand internationally, et cetera. And so all these are considerations to keep in mind that, for example, if you have an idea and you are knocking down the door of VCs who don't even invest in seed stage businesses, you're already wasting a ton of your time. And so simple screens for these sorts of things can save you tons of hours and frustration. And the final point on learning from rejection is that rejection is a part of the process, meaning that VCs are very busy. They're looking at thousands of companies. You may have the next Coinbase or the next Facebook. However, the human being who was charged with looking at your pitch deck, they may not have slept that night. They may have something else going on in their life. Or everyone may love what you're doing, but the one person who sits on that investment committee who has the yes or no just doesn't get it. That doesn't mean that your idea is not valuable and going to get traction. That just means that this person didn't see it. And I would like to say that, you know, God will just catch up with them on the next round. I say that to say that's the mentality you have to have. You have to be relentless, as the original name of Amazon, since we're in Seattle, the first name of that company. And I think you can check it right now. If you go to relentless.com, it will redirect you to Amazon. That was the original name that that Jeff Bezos had chosen. It tells you a lot about his mindset and what you still see them doing today. So with that, from a founder's perspective, I want to transition to think about what a fund manager might want to think about. And why am I saying this? I specifically am talking to you all about this in the context of startups and startup founders, because my 16 years of doing this and working on all different sides of these transactions, startup founders generally have no context for what it means when they're walking in the door trying to get money from a venture capitalist. They know what it means to say, can you give me your money? And here's my pitch deck. But what I mean specifically is they don't have any idea of the structures, the pressures, the investors, various things going on behind the curtain that allow them to be in that place to actually write that check or send that bank wire. So I'm not going to go too far in depth in it, but I do want to just give you guys a bit of a preview of what I do for fund managers and what a fund structure looks like. And I'll pause and just say a couple of things about this. This is a simplified structure, which is called a master feeder structure. Now, if you're a venture capitalist or you work at a venture capitalist fund or you want to work at one, what this structure is going to show you is two different things. And we'll start in the middle. You'll see three different dark blue boxes all in parallel. The first box will say master fund. The second box will say a feeder fund on the left. And then on the right, you'll also have a Delaware fund. What this is referring to is that when a venture capitalist is raising money and they're taking in investment, the US tax laws, again, I won't bore you this early in the morning, but when you're taking money in from US persons, whether that's an individual or a company, you have to do things that satisfy various tax rules. But if you're a venture capitalist and you're raising a large fund, your investors may not be only from the United States, right? You want to take in all the money you can because you want to grow your fund. Now, if you're raising money from a pension, like Washington State Pension Fund, they're tax exempt, just like a church or a foundation. They don't want to come into the Delaware fund because they don't want to have the same tax treatment because they are tax exempt. Therefore, that's why you have these structures here. You'll see they're feeders. And what they do is all these things are doing is that center box, that master fund, they're feeding capital from the left side of the screen and the right side of the screen into that master fund. And so when you get your check, that check is coming from that master fund down into your account. So if you're a startup founder, you're at the bottom that says investments. Now, why does all this matter? Well, understanding when you walk in the door, what type of fund you're talking to, where they're based, how large they are. This is what's called a master feeder structure as I started off. Typically, your largest funds are set up like this. So let's say folks like potentially Ascend, folks like new enterprise associates, just very large venture capital funds managing anywhere from 100 million to billions of dollars. And they're doing this because they're taking in money from all over the world. They may have a specific team that only does healthcare tech, and a team that does legal tech, and a team that does sports tech, and a team that does, and so on and so forth. And just even understanding that will help you route to the right person. And it will also signal to them that you're just not, a spring chicken and don't really understand what's going on, because most founders actually have zero idea about anything here. Now, I won't spend too much time on this, but I'll just quickly show you and point out a couple of points that are worth keeping in mind. When you see in the top, you see GP carried interest and you see management fees. So what are those? Management fees are the fees that a management company of a venture capital fund will charge their investors every single quarter, usually. That is, for example, fees to hire employees, fees to rent office space, fees to fly and go see you as a founder, fees to take you to dinner, etc. And that 20% carried interest, that's referring to a special tax treatment, but that's the money that a GP gets to split with the investors when the Facebook or the Amazon that we know today, when it becomes public. That's the money that you get after holding an investment for a longer period of time and ushering founders from their original seed stage all the way up to an IPO or to further sale or M&A. And so that's how the VCs actually earn their money. And why does that matter? Well, we start off about founders, and I mentioned thinking in bets. The VCs are thinking in bets in the context of the economic payouts here. That's why it matters to you if you are a startup founder. Because, for example, if a fund is investing, and let's say they have 20 different investments and they're a first-time fund, and you are one of the star performers in their portfolio. So out of 20 investments, let's say you've learned over the last 2 or 3 years, you're getting wine and dine. When everybody picks up your phone calls on time, things are going great. That gives you an inkling to know that actually you may be one of the better performing portfolio companies, which means if you do well, they do well, which matches the math here. Now, I won't go any further on this, but I'll just show a couple of other structures to give you an idea. This is more of a simplified structure. Let's say if you're a fund manager, to turn to that cohort, and you're looking to start your own first fund, your first vehicle. What we do is help folks set things like this up. And what you're doing in this case as a fund manager is you are effectively doing the same thing that founders are doing. So founders are going door to door pitching their idea for investment. VCs likewise are going door to door pitching sovereign wealth funds, state pensions, high net worth investors for investment into these vehicles that I'm describing here. Now, on the last one, I'll just limit the discussion here, but what this is called is a parallel fund structure. Now, what a parallel fund is just, it's set up in the context of tax treatment. So let's say I'm a large Seattle-based venture capital fund, and I've got a huge client based in the EU. And because they're in the EU, there's all sorts of tax rules and things. They may require a parallel structure, which is exactly what it sounds like. It's one investment on the left and another investment on the right, and they're mirroring each other. But the reason they're mirroring each other is because the underlying investors have a fundamentally different tax treatment. And the VC may make the decision that it makes more sense to segregate things and invest, $100 from Delaware Co. into your startup and another $100 from offshore fund into your startup. And you basically are getting two different bank wires. And the reason for that is the tax treatment piece. So again, I won't bore you with discussions of tax, but these things at a high level are all driven by access to investor capital. So just like as a founder, you are seeking to get them to invest in you, the funds that are investing in you are playing a version of that same game by structuring themselves in a way that can attract that investment. And the economics kind of plays out as it does here. Now, to kind of end this section on my slides and things, I'll give you a real world example here. And I put some Easter eggs in here. Does anybody here know what Cascade Asset Management Company is? Raise your hands. Cascade Asset Management Company is the family office owned by Bill Gates. Cascade Asset Management Company, if you go walk 2 blocks down the street from here, they are the owner of the Four Seasons Hotel. The Four Seasons Hotel during the dot-com era, about 98, 99, that was actually one of Gates' largest investments. It was what's called a take private. So most folks don't remember this, but the Four Seasons used to be a publicly listed hotel company. Bill Gates and some folks in the Middle East joined forces via his family office, which is a structure like just discussed. There's a bunch of different permutations on it, but they joined together, took the company private off the US stock market, and the Four Seasons has been owned by him and those group of investors ever since. And so it's a big deal because back then, it was one of the first times ever that a large luxury branded hotel had been taken private in this way. And you can think back, this is over 25 years ago, right? Look at how every major hotel brand has kind of copied them, from Marriott's, the St. Regis, et cetera. And that's an interesting model. Why do I put that here on the screen? Well, in the high net worth context, he's an extreme example of hundreds of billions of dollars. But folks who don't have that same level of finances can still do a version of that for their own life. You can do things like this with anything around $1 million or more. Another example that folks here may know of is you think about Marcy Ventures, which is Jay-Z's venture fund, Sean Carter, or Queensbridge Ventures, which is Nas's venture fund. So how are they structured? They are structured like this. Does Nas know about venture capital? No. Is he a great rapper? Yes. Does he have access to a lot of capital and a well-known name? Yes. So in his example, I don't know their exact structure, but what their structure is if you see on this box, you see the management company box in green. That's where a high net worth individual can go out to a venture capitalist like an Ascend and partner with them because they have the licenses at the SEC to actually make investments and do all those things. That's what a LeBron James, a Kevin Durant, you know, an NFL player, et cetera. That's what folks are doing to do what Nipsey said, which is all money in, no money out, right? This is equity. So that's the other reason I'm showing this here, which is equity. So if I'm just a high net worth individual and I want to take an investment into your startup in this room, I can do that by writing an individual check. But what venture capitalists are doing is they are setting up these structures because of 2 different reasons. One, they will have that equity in your business, but also the money that they spend to find those businesses to generate that return, that all becomes a tax write-off. This is exactly what folks have been doing in the community and a few more. This has been around since about 1978, these structures. And if you go far enough back, they actually go back to Warren Buffett. I just wanted to let you guys know that. Now, on the left, you see that real world. I put that in here as an Easter egg. This is actually the real world. I think 1997, which was Seattle, which was right down the street from here as well. And I believe where we get, well, for better or worse, where we get reality TV is actually the real world. That was the first reality TV from 94, 93, 94 in LA. And so I thought it was interesting to put that here. And finally, on the right-hand side, you'll see I list a number of the different types of investments that Cascade has done. And they're doing everything from real estate holding companies, agriculture and land, all sorts of private deals. And in the context of this conference, right, we're talking about stocks. Everything I've talked about up here so far is what's called alternative investments. And alternative investments refers to the broad category of non-publicly traded stocks and bonds and equities, et cetera. And so when you talk about taking the Four Seasons private, that's an alternative investment structure. When you talk about investing in a Coinbase, a Facebook, et cetera, before they're in the stock market, things that I mentioned that Marcy Ventures is doing, the things that I mentioned that Nas and folks are doing, those are alternative investments. That's how folks like Rihanna, I'm sure everyone knows Fenty. That Fenty structure mirrors what I just put together. It's the same concept. She set up a corporate structure. She was blessed to be in that position. She doesn't have to know everything. She can hire the relevant advisors to come in. She can take a piece of equity on the back end of these deals and then change her life and not actually have to do music anymore. And so what can we do with these structures here? We can do versions of the same thing. You don't have to have, $500 million to pull these things together. Now, there are some hoops to jump through, but a lot of those hoops are even changing in such that it's easier to actually qualify for a lot of these things. You can individually decide that I want to sit for a multiple choice exam, and you can now become a sophisticated investor is the term, and you can participate in some of these structures. I want to expose the group to this because this is the other side of the pie. So when you're watching the Come Up series and we're talking about, what NVIDIA is doing and what X or Y stock is doing, that's in the public markets. But if you think about it like a pie chart, like a pizza pie, that's really only about 40% of the pie. And the reason for that is manyfold, but historically, folks couldn't participate in a lot of these types of transactions. But again, that is changing. And so when you start looking at the real wealth that people have been able to accumulate over the last 20 or 30 years, specifically, you look at a place like Seattle, right? Microsoft, who doesn't use their products in some capacity? I'm pretty sure the whole United States is using Amazon in some capacity. And so these all came from private markets. And I want to just set the frame and the tone, and I'll pause after this and take questions that anyone may have, which is, if we think about, and I'll come back to my founders, you're a founder and you're trying to raise capital in this current environment. One thing I'm really big on is context. So when I was in high school, parents and teachers will always tell you to do this thing or do that thing, but they don't always give you the context, the why. I'm a why kid. I needed to know exactly why I was being told to study physics and why I was being told to learn this or that and how it could maybe potentially help me. So I'll give you a couple of whys today in the marketplace, which again, it's not my direct area, but you're going to hear from the guests over the next few days on. And I want everybody to hear, to keep it in mind. And also you can use some of what I'm telling you to ask questions around these topics for the additional speakers. So first, everyone probably noted earlier in this week, the Federal Reserve dropped interest rates 25 basis points. You don't have to know what that means, but the concept is that interest rates represent the price of money. It's that simple. Interest rates equal price of money. Why do you see on the news stocks and bonds moving up and down relative to that? Well, again, to oversimplify, there's a lot of different things going on there, principally the strength of the dollar, up or down. As someone who lives outside of the country, you might hear the dollar is down, but I can see it in other ways, because when you have to do currency conversions and things, you start to see these things. Now, in the venture capital context, let's connect these threads. If I am a founder and I am raising money from a venture capitalist, I'm going to give you a couple of periods of history of why understanding interest rates can matter for you as a founder, even if you are not inclined to care anything about economics. One, the price of money feeds into the financial models that venture capitalists use when they start to value your business, to assess you are the Uber or the Lyft of this other industry. When they assign that TAM to you as a founder, when they assign that TAM, part of the underlying logic behind the financial models is the price of money. The price of money is also called the risk-free rate. The risk-free rate is the rate at which, if you just put some money in a money market account, you're going to get that 4%, 4.5%, 5%. So when the Fed cut rates the other day, they lowered by 25 basis points the amount of interest you're going to get on money just sitting in your money market. That brings it home. Everybody knows about that. Now, that means that's also referred to as a hurdle rate. So if I'm an investor and a venture capitalist comes to me and says, give me $5 million to invest in my VC fund, the venture capitalist now wants to know, before this Fed meeting, they want to know, is my investment in your venture fund going to generate more than 4.5%, which is the risk-free rate, the rate at which I can just sit money in money market, take no risk, and do nothing. Now, when you drop the federal funds rate from 4.5 to 4.25, you have now lowered that risk-free rate. That means that if I had tens of millions of dollars in a money market, instead of getting 4.5% interest on that tens of millions, now I only get 4.25. And when you hear in the news, folks saying we want to drop these rates back down to zero and all that sort of stuff, zero bound, et cetera, what that is doing is it's forcing those investors who can just collect those coupon payments, it's forcing them off the sidelines because they can no longer get that 4.5%. If rates go down further, it goes from 4.5%, just think about a big number, 4.5% on $100 million, 4.25% on $100 million, 3.5% on $100 million, 2.5%. Each time these rates start jumping down, especially when they drop drastically, that spurs investors to answer the phone when a VC makes the call. Think about that. That means that the VC has an easier time raising money. When the VC has an easier time raising money, that means he has more money to make investments. When he has more money to make investments, then he can make more bets. In my earlier example, instead of making a bet on 20 companies, maybe he can now double his fund size. He can make a bet on 40 companies. Now, you as a founder, as you may intuit, you may now have more bites at the apple. Because even if you're a seed stage business, the opportunity set of having cash sit in the bank falls with interest rates. That's why risk and speculation rises accordingly. That's why you saw during the 2020 to 2022 era, GameStop doing what it was doing, why you saw various crypto assets doing what they were doing. It's a little bit more complicated than that, but the real genesis of it is that as these rates drop, money has to get put to work because money never sleeps. And if you have tens of millions of dollars or billions of dollars and you're getting 4.5%, and all of a sudden you're getting 0.25%, there's another concept of real inflation versus actual inflation. So like negative real rates. So if the government is telling you, I'll bring this home right after this, if the government is telling you that the inflation rate is only 3%, you and I know that's probably not true. Now, if the interest rate is 4.25% and the inflation rate stated is 3%, that's 4.25 minus 3. But if real inflation is 5% and the interest rate is 4.25, 4.25 minus 5 becomes a negative number. That's the concept of negative real interest rates. That's a bigger topic, but why do I highlight this here specifically for you? These topics impact the ability of capital allocators to both raise capital and your ability as a founder to get access to said capital. Because as these levers and prices of money go up and down, it actually makes it easier or harder. And so when you see things like, or hear things like the Fed's on a rate cutting cycle, that is a signal to business owners, to capital allocators, to entrepreneurs to get ready for the access to capital that is coming. And I specifically want to end on that and let folks, kind of take what they will from that. But I also want you to keep this in mind as you hear the rest of the speakers today. And folks are talking about all sorts of topics around investment. Regardless of all the other things going on in the world, we all have families to feed, and it's incumbent upon us and everyone here who I've seen taking notes, you are ahead of that curve by listening to speakers you're going to hear today. So with that, I want to say, thank you, and I'll open it up as well. If there's any questions, I'm happy to answer. Finally, as well, if you see that QR code there, that should work and connect to the link tree that I have. So if folks see the other things that I have going on, I think Mark is walking around right now with a microphone. But if folks want to kind of connect with things I do, I have educational content, all sorts of things, social media. You guys can connect by scanning the QR code as well.
Hello. So you mentioned something about sophisticated investor and taking multiple choice question. Can you just elaborate on that a little bit more?
Yeah. So about 2 years ago, the SEC passed some, and they're in the middle of passing a lot of changes to rules. I'm sure everybody's seeing every day. There's new things coming out. But there's an exam called a Series 65. So when I talked about these private investment funds, historically, meaning post 1929, you couldn't invest in a venture capital fund as a quote unquote regular person because the government would say you need to be an accredited investor. Accredited investor is a defined term, and it means you have either a combination of $1 million in the bank, excluding your home, and or you make over 200K a year for the last 3 years. The rules have changed every couple of years, but that's roughly what the rule is. The SEC recently has made changes such that you can sit for a Series 65 exam, which is a multiple choice exam. Anyone can study for it. You can take it, I believe, as an 18-year-old fresh out of high school. If you pass that exam qualifies now to be an investor. It's not a hard exam. It's just kind of basic law school type stuff around what securities are and what's fraud and what you can, it's actually good education. But what it means though, is when you see a venture fund now, if you just take that, let's say you're not an accredited investor and you just want to get access to these things, you can take the time, sit for the exam, and now you can go to all these VC funds. And when they ask that little check the box on the site, am I an accredited investor to get access to the documents and the information? You can now check yes.
Oh, hey, how you doing? So a quick question.
Very
I'm a
good.
wealth advisor. So just for people that are investors, what would you say, what percentage of the portfolio should be allocated to alternative investments like this? And then at what wealth level would you say that needs to be? So of course, we talked about being an accredited investor. You can also do it with a Series 65 and also with a net worth $1 million or more. So what would you say, what portion of somebody's portfolio should be allocated to alternatives or private markets like this? What would you say?
I guess I would have two answers. One, if I were to say this like 10 years ago, it was much more difficult because the reforms I mentioned with Series 65, crypto really wasn't something you couldn't really get on Coinbase and do anything like the way you can do now. The difference now is you can, I won't speak to say that all that crypto is, something everyone is for everyone, but I will say, and I didn't even talk about this, but as an attorney who's been involved in crypto since 2015, when the Gemini exchange first tried to get their first Bitcoin exchange, I was the one drafting those applications to the SEC and they got rejected. The industry has come a long way. I would consider all of those things, unless you're really an expert, as basically speculation. And to a percentage number, I don't give investment advice, but I would say it's going to need to be a risk-adjusted number that's relatively low if you are not comfortable with or understand kind of what these things are. So crypto as an asset class is effectively a private asset class that, because of technology and innovation, became publicly available. Outside of crypto, let's say in the traditional alternative space, what most folks would look at is a percentage anywhere from 5 to 20%, depending on the main factor is going to be when do they need that money, because the investments tend to be illiquid. So when you're in a fund structure like I showed, you're typically locked into a structure for 5 to 7 years on the VC side. A hedge fund, something that's going long and short, we didn't go through that, but long Apple, short, et cetera, short NVIDIA, that is a fund. Those typically allow you to redeem quarterly, meaning you can quarterly just get your money back. But in each case, you need to be basically comfortable with the risk of loss and comfortable with that position size of that bet. So, you wouldn't take 100% of your net worth and put it all into something illiquid, because if something happened, you're basically done. And at the same time, prudence would say somewhere around, 5 to 15%. And with that, I will say, I am an attorney, but I am not your attorney. And everyone here should make sure that you do your own research. And also, it is very important to understand. I want to explain these concepts because oftentimes they're hidden behind a cloak. Like I worked in all these big law firms. This stuff is not explained to the people, right? And it's important that people really understand these things because this is how a lot of wealth is being created. And when I say these disclaimers, it's one, because you're required to say them, but also the real importance here is not just, betting it all on black. It's really the educational component. Because it may take you 3 or 4 years to decide you're comfortable to do any of these things, or you may never be comfortable. But you are also learning about an area that you may have had zero idea about. And that in and of itself is valuable.
If you have questions, just come over here.
Hey, Corey. My question is, companies like Robinhood recently came out and said that they're launching a venture fund to be able to basically decentralize the access for retail investors to now jump into the private markets. What are your thoughts on that specifically? Yeah.
I think that's tricky. I think it's a good thing that people have access to these markets. At the same time, I think that if it's abused, it can be a bad thing. And what do I mean by that? If you think about it, like with this group especially, okay, trading options. Options are great, but they're highly volatile and you can be set for life or you can lose it all. And so that means you have to do what's called risk adjust your position sizing. And it's the same thing in that Robinhood example. I think that there are going to be examples of people who kind of make the front page of magazines or the front page of the internet for doing well. And there's going to be the counter as well. People who make the front page for losing it all and betting their house, which is, if you think about it, it's no different than going to Las Vegas and betting it all on black, right? So just because you wouldn't do that at a casino on the Las Vegas Strip, you shouldn't do that in your house on the internet.
Hello, question on Databricks. So you're familiar with the company as well?
Can you repeat?
Databricks. I was
Yes.
trying to use it as an example. Can you talk through why a private company would continue to raise? They recently raised a Series K. I'm forgetting the round. At 100 billion. Interest rates are currently dropping. Can you hypothesize on why a company would do that, even though they're valued at 100 billion as interest rates are dropping? And again, just your hypothesis on hearing that.
Yeah. So I have worked with private companies who've raised, private credit, raised financing rounds, all that, all these fancy terms. Private credit just means debt. That's it. It's not fancy. In the Databricks example, what I would hypothesize, having worked with CFOs and CEOs, they raised because their cash burn, they needed the money. They needed the money likely to make payroll for working capital is what would be called working capital needs. But the other reason, if they're at Series K, I'm not sure, but let's take what you said. If they're at a Series K round, that means that they've gone through Series Seed, A, B, C, D, E, F, G, H, I, J, K. Generally, when you get to those late stage rounds, they may be borrowing in prep for an IPO. They may be borrowing to pay down prior financing rounds of debt. Because to get to that level, the CFO is basically, what did Jay-Z say once? My CFO deserves the Medal of Honor in one of his songs. That's effectively what you have had to do as a CFO to keep a startup at that level. And what do I mean is they're likely using that capital for a number of reasons. One, working capital. Second, paying down debt. Third, potential earlier investors in their financing rounds that were like large anchor investors in the private markets. They're likely saying, hey, we need to get a return for our own investors. And that's in order to pay them off and allow them to sell out in what's called a secondary, which is a sale of your private shares to a third party. So I think it's a combination, most likely, of all three of that. It could also be something like merger and acquisition, where if you're going to go acquire a business, you may not want to take out other types of debt. You will raise some cash plus what you have, plus other things. So it's definitely a financing move, but I would say it's likely to do with the working capital and then letting prior investors exit their cap table. Welcome.
And we got another question. Yeah, so if you guys have questions, just come over here. So that way we can streamline real quick. I'll be going all the way around, you know. Okay. All right. I have a feeling that this is about to be a major question. So let's do it. Let's do it, brother.
Just a question. It sounds like obviously you got some background in terms of crypto legislation and whatnot. Is there anything you can share there? It seems like the next coming years right now, obviously we got the whole market structure that still needs to pass, but then like RWA and just how that kind of lines up with private credit, private equity as well.
Yeah, I mean, okay, so where to begin? So I work with, it's not discussed on there, there's too many things that I'm doing, but with crypto projects that are US based and non-US based. And on the legislative side, I've got, if you check that QR, all sorts of content around the topic. But I think what we're witnessing there we go. What we're witnessing real time is a tokenization of assets. And what does that mean? Let me break this down. I believe it was 1960, around 1960, what we now think of as the modern stock market was originally all paper tickets, literally pieces of paper on a pusher moved from one part of an office to another, and that was how trades were executed. After the 1960s, the SEC actually worked together with a group called DTCC, which is a depository trust corporation, and what they did was they turned that literal pushing of paper process into an electronic process. So not computers like we think of it today, but computerized in a way. What is going on now? There's a lot of noise of what's going on with the crypto sphere, but I would say on the legislative front, specifically in the US, there's two things that I think we're going to see very shortly. We've already seen what's called the Genius Act, which is the stablecoin legislation. A stablecoin is not really very different from the current US dollar. It's just a digital version of the US dollar. But why that legislation is so important is that it's the first time the United States has allowed financial innovation in the context of the banking sector that is not state controlled since the turn of the 19th century. Meaning startups can now innovate on financial rails. Historically, you need a bank charter, you need a ton of capital, you need a federal, what's called a window, a Fed open market account. These are all things that are basically gate kept. And what the Genius Act did was said that for a lot of what we would call neobanks or fintechs, banks like Mercury, Stripe, Brex, et cetera, that you may have heard of, they now have an easier time innovating on financial rails to offer services in a way that a bank would never do because they're already rich. Why innovate? Now, the current legislation, which from everything I hear is going to come before the end of this year, is what's called a market structure bill. The market structure bill is designed to do one key thing. It is designed to work with the Genius Act, which only covers stablecoins. So think, you know, Coinbase now offers, as of like yesterday, Coinbase will now offer you 10% interest on your stablecoins if you deposit them through Morpho, which is a whole crypto project. I won't go into all the details of that, but if you think about it, you can take $1, convert it into stablecoins, and gain 10%. Whether or not you should do that, the risks underlying that, how they're generating that yield are all separate questions. Now, in the market structure bill, what the government is looking to do is literally, and I've read most of these bills, they are literally working to allow the tokenization of our current financial system. So in about 2 weeks, Chainlink is going to have a meeting in the EU with SWIFT. SWIFT is the international system for sending bank wires and payments. So, Chainlink is now connecting to your real world assets question. They are serving as the bridge between the credit quality of Facebook or the credit quality of Microsoft as a corporate bondholder and the ability to trade that asset on a blockchain. So we're literally living through basically what happened 25 years ago during the dot-com era of everything kind of moving online, Netscape having the first color browser, you being able to watch a video. We're looking at this in the context of finance, though. That's the part that's very different. Do I think there'll be a ton of hiccups and ups and downs? Of course. But what a lot of the policies you're seeing, what they're trying to do is they're trying to grow their way out of a lot of the economic issues the country has. If you compare and contrast it to Europe, where they're taking a whole different approach, which is basically stay in place, that's the difference. And the rules and the changes the SEC is making, as of last week as well, they changed the rules so that now they're proposing to change the rules so that public companies only have to do audits twice a year versus 4 times a year. This will mean, and they're changing the rules as well around, we're trying to change the rules around class action lawsuits. Take the opinion of whether it's good or bad aside. From a business owner, someone looking to form capital, this now means that when you want to go public, when you want to take your startup right off Pike Street over here or one of these other avenues in Seattle, when you want to go public now and you go to PwC and they tell you it's going to be $1 million in audit fees for your first year as a public company, now that number may have gone down to 300K. They're trying to allow these things to happen to kind of boost economic activity. And on the crypto side, it's the same thing. They're trying to encourage the competition to force the JP Morgans of the world or the large institutional banks to actually have to move, right? Because when you're in that position and you literally own all the chips, you don't actually have to do anything. And so who knows whether or not it's going to ultimately be successful, but the underlying goal of the policy is to force that innovation. And everything that I see in here is that that's going to happen before the end of the congressional session, which is going to be this year. And so we'll wake up one day, probably in 2025, and the legislation will say that now, you can start all these things on chain. You can, if you're a crypto project with US citizens outside of the country, you can now come back into the country. You may now have like certain tax benefits. It may now be easier from the things the SEC is doing for you to take a company public. So to the gentleman's question earlier, where that company was a Series K, to me, that's a sign of a market failure. If you have a public market, you really shouldn't have companies that are raising private rounds all the way through the alphabet like that. Because why would you do that? We have founders and wannabe founders here in the room, aspiring founders. You would stay private because you've talked to the investment bank and you've talked to the various compliance parties, and they've told you that, look, if you're public, the cost to become public is X millions of dollars. And now you have to get on earnings calls every quarter. And now every single structure and pay package, et cetera, that you do for your employees, somebody's asking you about that and you're having to face litigation and things. And so what do founders do? They say, you know what, I'll just stay private. And so the attempt, again, whether or not it'll be successful and whether or not we kind of agree with it, the purpose is to really kind of turbocharge innovation and create challengers for financial incumbents.
We got one final question.
Okay. All right. My first question, Corey, is what type of regulatory or compliance restrictions are you subjected to, or even the founders are subjected to in terms of even with stock reporting? And then,
Can you repeat?
Okay.
Regarding stock reporting?
Yeah. What type of regulatory or compliance regulations are you restricted to from the founder perspective or even the venture capitalist perspective? Are you required to report
As a
trade.
private company, there are not really restrictions. The biggest issue is going to be things around stock options, how they're dated. That actually all goes back to the .com era. So, for example, I'll give you an example, and I've got YouTube content and things like that on this, but the backdating of stock options were like, let's say, so what was happening around the year 2099? All the big tech companies were recruiting, engineers and tech people from one company to the other, but their stock price is moving up so high every week. And they would say, oh, hey, if you leave us next month and start in October, we'll date your stock option package as if you started in June so that you can take advantage of all the price rise in the shares. And they were using that from a business standpoint as a tool to like recruit talent. But the government was like, no, you can't do that, because it started leading to all sorts of, fraud and things. As a private company, those are the main areas that you have to think about from a reporting perspective. On the public company side, pretty much all compensation of your major executives, in quotes, so CEO, CFO, general counsel, all that has to be disclosed in securities filings.
She had a follow-up question for that.
And can you give any tips for protecting your IP while you go through the process? Not every company is going to be reputable. So how do you protect your?
Yeah, that's tricky. So I'll give you two thoughts, and I do have some like public content on this as well, or the blog posts and or YouTube. Generally speaking, if you are doing a pitch, most VCs are going to say, like, we're not going to sign an NDA to look at your pitch deck. And that's kind of industry practice. Now, what does that mean? It's not an onerous thing for a VC to tell you that. The main thing that I would say, and again, this is generalized, kind of advice around the topic, but the main thing is that as a matter of common sense, you wouldn't put, trade secrets, proprietary information, your secret sauce in a pitch deck that can just be forwarded via email, because most courts are going to look at that and say, if you really cared about it, you would have kept it confidential, just as a matter of common sense. Now, the trickier question you didn't ask about, but I'll give you an example because I've written on this, is let's say you're a founder and a company comes to you and they want to acquire your company and they want you to sign an NDA. Well, there's all sorts of language and trickery that may get put in these NDAs, not necessarily a pitch deck, but let's say somebody says, hey, we might want to buy your company, a big tech company, they might want to buy you for $2 million. Everybody's excited and thinking payday, payday. Now, they send you an NDA and you just rush off and sign it. Especially on the West Coast, it's very common that NDAs have language that says something like, anything that we gain or learn during the course of our due diligence, you agree is ours and we can do with it as we want, et cetera, et cetera. That means that if you sign that NDA and disclose all your secret sauce, they have no liability if they just use that NDA as a pretext to just learn about your IP and then create that product. And so that is the biggest thing I see that can get startup founders tripped up, provisions like that. Because again, I won't name a big public company, but like a big public tech company or companies, that's kind of their modus operandi from a acqui-hire acquisition standpoint. Because if you sign language like that and you haven't read the NDA, they can then come to you and say, we don't think your company is worth $2 million, we think it's worth $750. And you say, no way. And then they can say, well, you can sell it to us at this, or we're going to build it and hire off all your employees. That's hardball, but that's reality. So those little provisions can mean a lot. All right, with that, thank you.
All right. Thank you so much, Corey. We appreciate you. All right, so we're gonna let you guys take a quick break because I remember last year people were like, hey, like give us some breaks, because that was a lot of information to digest. And on top of that, it allows you to, if you want to sit back and talk to Corey as well, just for a quick second, you can do so. So we're gonna probably take a quick like 10, 15-minute break, and then we're gonna get right back to it. So go ahead and stretch your legs, go to the bathroom, Get you some water. We'll be right back.
So just went over 1 hour, myself taking selection. This one underneath, like, real pizza. A UK producer called Scotty D. Like music from DJ Kwanzi. And they smiles. European 305, 305. Music from NR Green as well. One of my favorite cuts from MFR Souls. And of course, a couple of pieces for myself too. Once again, we're gonna go up one more gear. So keep it locked. This is Selection Radio. Myself, Hagen.
Yo, 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 yo. Ladies and gentlemen, we need you to make it back to your seats. All right, so how many of you guys are watching the market right now? I sense some happy people in the room. That's dope. All right, so we're going to make a quick scheduling change just as a heads up. So what was supposed to be at this point in time, we were going to have a VC Fireside chat. That's still going to happen, but given what's been happening lately, we probably need to have some conversation about what we're seeing in portfolios and charts and everything else, right? Okay, so what we're going to do in this segment, we're going to discuss customer experience with my good brother, Jimmie Lee, who's going to drop some serious knowledge bombs on y'all. And then after that, we are going to go right into the next one where we will have a fireside chat with me and some of my favorite traders. Can we do that today? And then we'll let you take a break. And then we'll come back and then we'll have the VC fireside chat. Sound dope? All right, so how y'all feeling? Let's try that again. How y'all feeling? Okay. And hopefully the people that are watching us live virtually, they're enjoying themselves as well. So, all right. So I'm going to bring my brother up here, Jimmie Lee. Just here's some cool nuggets that I know about him. He's amazing. That's already one thing right there. Anytime when I give it the stamp of approval of amazing, then you already know it's going to be dope. But two, I mean, comes from not only engineering, but also from a business acumen background. I mean, he literally gets into the anatomy of things and also just really has a willingness heart to try to help people as it pertains to getting to solutions and building dope things. So he's, you know what? I'm not going to give it all away. I'm going to just bring the brother up on stage. Give it up for none other than Jimmie Lee. He's amazing, y'all. Welcome. Just as a heads up for all speakers that will be up here, just make sure you speak into the mic so that way people can hear you clearly, but take it away, brother.
Thanks, sir. Thanks, sir. Love you. Love you. How's everybody doing? I know he just asked that, but it was a lukewarm response. We good? All right. That's lovely. That's lovely. I know some of you were up really late. Some of us were still up really early. And I don't want to be the one that's 2 steps from keeping you from lunch too long. So we'll keep this brief. Now, just a quick pulse in the room. I am an engineer by trade, by experience, by everything, but I'm also business minded. I am not your trader like Mark, so I can't go there with you, but I do want to get a pulse in the room because I want to make sure whatever time we spend together is valuable to you. So in that regard, how many people want to really hear about super deep tech customer experience? I thought so. And then how many people want to hear about the strategy and understanding how to spot and how to build, how to scale, how to build for scale, and how to take your idea and make money out of it real quickly? Who would prefer to hear? I think the hands have it. All right, so Mark, you good? Not geeking out and kind of going at a more strategic level? Awesome, awesome. So a little bit about me. My name's Jimmie Lee, as you see on the screen. My website's there. If you want to connect or find out more about me on LinkedIn, you can scan the code. Now, I'll try to slow down my speech, but I do know some people have some transcribers out there. So if you want to pull out your transcribers, your Fireflies, your Notions, your Jivas, if you want to transcribe with your phones, you want to start taking notes, give you a few moments, get ready. By way of background, a little bit about me, what got me into tech. I met Mark, I want to say, was it 2011? My Unfold, he and my wife go back, way back. I think it was church community stuff. Yep. So I'm born and raised in Tacoma, 30 miles south here of Seattle. And where I was born, it was more of like, we built a neighborhood from, y'all might know it, called Hilltop, which was a not really colorful place in the 80s. I guess I'm dating myself now here. And so school, when I was second grade, my mom brought home a pager. And I was like, what's that? She's like, a pager. She's like, oh, it's got numbers on it. And I was like, okay, how does it work? You know, I'm not even 10 years old at the time. And she said, well, people call this number and they put another number in for you to call them back. And I was like, okay, well, at some point, that pager is going to have letters. Wasn't even 10 years old yet. The next thing, she was a real estate broker, small business person. I kind of went into homeschool. So I was homeschooled after the second grade. And she paid the bill on a Friday. To them, for those who in real estate understands that. And she went back to the office on Friday and couldn't get into the multiple to pull some data out for her customers. Well, I didn't know. I was, she had bought an old 386, 486. Who remembers DOS shell, command line, before Windows 3.1? She had bought this, this computer, dumped it in the living room. I'm in the third, fourth grade, so I mastered DOS shell in the third grade. She said, I can't get this data out of the computer. You need to come help me. I said, okay, I'll try. He knows where this is going. I didn't know it was those old dial-up modems, the ones with the beep, 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 right? I mean, some people in here get me, right? Who remembers the fax machines, right? The word processors. Kids don't know how they got it these days. But I didn't know what I was doing. I accidentally ended up hacking into the MLS database, extracting the data out, helping her and her customers. Lo and behold, of course, the MLS calls her on Monday saying, hey, were you in your office on Friday afternoon? Well, yeah. Were you on the computer on Friday afternoon? No. Okay, who was on the computer? My son. How old was he? 10. Okay, here's the deal. If you bring him into the office right now, we're gonna send some folks in, and if he tells them how he got in, we won't call the FBI. So naturally, of course, I don't know, my mom, she's trying to prep me for all this stuff, and I was like, but they're not law enforcement. And this is a typical kid, so I was like, well, whatever, okay, I'll talk to them. Lo and behold, they start walking in. The total, who remembers Dilbert? The whole total Dilbert car, with the black slacks, the white, button-down shirt with the pocket square on the side, with the pin sticking out, all arrogant. They were of the dominant, gender and ethnicity at the time. And they were talking to me like I was nobody, right? Well, lo and behold, I had to tell them what I needed to tell them. I was snarkly about it. Of course, I was a little jerk about it, being honest. And past that time, but ever since then, I knew there was something about technology, but there was nobody in my neighborhood for square miles. There was an engineer. So what we're going to be talking about today is the stuff they don't tell you. And so I might, unintentionally push some buttons that may not be buttons that people want pushed. But if somebody were to tell me what I know now, 20 years ago, I shudder to think what I might have done. And so we'll walk through a couple of scenarios, but most importantly, what I'll do here briefly is I'll ask a couple of people in the audience what they're up against. And we'll use those examples in real time to start talking about customer experience, building for scale, decisions you should make, decisions you should not make, and don't make the mistakes that I made. I've been fortunate enough, thankfully, to launch a number of businesses. Each one of my companies, thank to God, is purely a blessing, were able to get to over 250K in revenue in less than 6 months. I would like to say that a lot of that was luck. And I'd love to say that I was just on a lucky streak. But just like any other business, businesses ebb and they flow. As high as you have highs, you will have lows. But what they don't tell you is you prepare for the lows on your high, not when you get there. Like one of the number one things I think a lot of people in the room are going to nod their heads at is the best time to go and work on your extra business capital and loans is when you don't need it. So we're going to get into this if we're talking about customer experience, but most importantly, how do you scale from a strategy perspective? And how do you prepare yourself and prepare your company to prepare your ideas, or how do you evaluate good ideas, right? It used to be the hardest part was taking that idea from a business plan and then putting it into technology. But now it is my opinion, after a lot of research and hundreds and thousands of conversations, that the technology is no longer the core value aspect of the company itself. It's actually its application and its ability to drive revenues and customers and keep those customers and avoid this number one word that every founder needs to hear, churn. But now what we're entering this age at is this vibe code world, good, bad, or indifference. The main core objective of your business is how quickly can you scale sales, how quickly can you land storytelling, and how accurately can you maintain customers. So when you talk about customer experience, it used to be all like how a pretty nice front-end application that looks pretty, that's responsive, works on phone versus tablets, that is this cross-platform, that's multi-cloud, all these buzzwords that sound really, really cool. You used to be able to kind of spurt those, in front of VC firms and investors and funders, and it sounded really, really cool. You're on the right track. Now you just start throwing AI, LLMs, blockchain, right? Now, it sounded pretty cool. Oh, what do you do? Well, I found this problem that I kept experiencing every day. And I talked to 20 other people, and they said they paid me $20 for it. So I went and I vibe coded this application, and all 20 people, they paid me, man. So come and invest me. What are you raising? Oh, I'm raising, $1 million or $5 million, Like, what? That's not what the value is anymore. So what's the real value? The real value is understanding the core, not the core problem sets, but getting ahead of not just what they're going to pay for today, but what they're going to pay for tomorrow. The problem used to be you were racing to build something because you're trying to build it so fast before somebody else either competed with you or before the problems started to change, before it started to shift. So we got into this rapid development cycle. How quickly could you build? How quickly could you create a technology? How quickly could you create a platform? And how quickly could you speed the market before somebody else was competing against you or those problems started to shift? But now that we have vibe coding, you can do that in a weekend. And anybody can do it in a weekend. We're not going to get into how maybe insecure, unscalable, how long that might last, how easy it might break, how many users it could use, but that is no longer the core value. So what is the value? The value lies within your why. This is why I talk about storytelling. This is why I talk about what's really behind, what's really driving, not just your willingness, your eagerness, your desire to build a company, but what change are you trying to make in the world? Rewind this all the way back to the show Silicon Valley. Anybody seen the show Silicon Valley? Oh yeah, we got some cable payers, some cable subscribers in the room, right? And it used to just always like, I want to change the world. That was the biggest thing. We're going to change the world. I can turn this into a charismatic speech, get everybody fist in the air, pounding on the desk, excited, jumping up and down. But at the end of the day, it's all about execution. So we went into this from this strategy perspective into this execution world, to this changing the world. I want to change the world. But now we all can code. We can all have an idea and build something over the weekend. So where's the real value? The problem that a lot of funders have in finding these businesses that are super attractive, that are investable, is that people build products, they get 100 people to buy it, but they're lost in this, why am I doing it in the first place? And so my core relation is, if you can't understand your own why, you can't apply a why to your company. If you can't apply a why to the company, you can't apply a why to the product. Every company has a product, but very few products are actual companies. But every company and every product must have a why. And so this gets to the core essence of who you are and what you're trying to build. So I want to ask somebody in the audience who's bold enough to be vulnerable enough in front of all your cousins, somebody to give me an example of either a company that they're willing to build or that they want to build next. And we're going to dive into that and show you how do you really get to a point of building for scale, understanding your why, applying that why to a strategy, then taking that strategy, applying it to a product, and taking that product to scale. Is that valuable? Or should we pivot? Because I will pivot. All right, who's going to be bold enough to be our first example? All right, well, how do we do two? Why don't we do, he'll go first, he stood up, and then we'll go, that work? All right, what's your example?
Company called Fireside Agent. The idea is to help ratio between independent artists and mental artists by creating a platform for them to have options that they could be able to learn how to create. So that would be big engagement, networking, touring,
Okay, so his example is he's building a by agent AI app to separate big label artists to non-label artists, a all-encompassing platform to help them build, create, share, and track their earnings.
Kind of simply just think of a software that would do what a personal agent would do for a major artist for an independent artist.
So pretty much a label in a box.
Yeah.
All right.
Team in a box.
A label team in a box. All right, one more time for the camera. Just one more time for the camera.
Okay. Where's the camera?
Can the people in the back here now? All right.
Okay, so I'm building a platform called My Personal Agent, and the idea is that the top 10% of artists in the music industry have teams to help support and grow their career. However, most of the music industry is comprised of independent artists, so if they want to compete with major labels, they have to do all of that work alone. My Personal Agent is a platform that's designed to be a team for them in a box.
Let's give them a pause. All right, so I know about 2 clicks and 5 snaps about the music business. So we're just gonna admit that right now. So it sounds super amazing. A couple of things that pop off straight off the top when we're talking about customer experience and building for scale is you're basically like Uber and Lyft going after the taxi cab industry. You're going after the music label mafia, right? Which is cool, which is great, but the fundamentals must be important, right? And so we're talking about customer experience. Now we're talking about not just what's going to attract these known artists, these independent artists, right? But now you're starting to, how are you going to differentiate from YouTube and Spotify, right? How are you going to provide a service that's going to go above and beyond and be more attractive than the licenses that they're already paying and they're already locked to? So the first thing I start to ask for is like, what technology are you looking to build that out of? How have you started building the technology? Have you started building tech? Have you shown it to anybody? Have you talked to anybody about it?
Yeah, I started building the tech currently.
Yes, I started building the tech. Currently, my app is in test flight mode. Yes, a lot of questions. So I like it.
Yeah, so basically, do you have any pilot customers?
Do I have any what?
Pilot customers, demo customers, beta customers.
Yes, I do. I have a few friends in the music industry, and they feel like the app is incredibly valuable for what they're trying to do.
Okay, so and let me know if anybody else has any other dynamic questions or so. So what I'm getting into here right now is, okay, so he's got an app, he's got a couple of people he's talked to. How many people are in the same boat? You built an app, you got a couple of people using it, you got some initial background, or you're looking to build a product, or you're looking to build an app. All right, so how many other people are more on the funding side, looking to potentially invest in a product, invest in an app, invest in a technology? All right, right in here on the business side. Interesting. All right, we got a bunch of room for investors, traders, finance people. All right, so we're gonna try to keep this interesting. All right, so the number one problem that most people have is the number one thing you should do when you're looking for a customer experience and you're building a product or you're building an app is talk to people before you build anything. First thing you want to do is talk, but let's go back a little further. The first thing you need to do when you want to build a product or an app and build a company is build a business plan. I don't know how many times I say this, but startups are SMBs, but SMB is a startup. But there's a lot of truth about small businesses and how small businesses are built. Solid small businesses that are built to last always start with a business plan and a strategy, not a pitch deck. And so what we often find is most people start as a founder or as a builder or as a company with a pitch deck. But I'm like, okay, but what are you pitching? Oh, well, our TAM, our total addressable market is this. Our sizable addressable market is this. If we have this many people we can sell to at this price over this time, and if I raise this amount of money, I can go ahead and I can increase my valuation of my company. Well, I'm saying, but you don't have a company yet. You don't have any, you don't understand if you're going to be an LLC or an Inc., an S Corp, or C Corp. You don't quite understand what your income streams are, how much it might cost to run. And the first thing you do is you start with a business plan. The next thing that you go into, and let me know, is this valuable? Yes, no. You sure? Yeah. All right, all right. The next thing you go into is after you start having a business plan is you start talking to people like, hey, I'm going to build this app. But I'm not saying you haven't, so this is not you. This is just generalities, right? The next thing you go into is saying, okay, how many people would purchase this app? Now, when it comes to vibe coding is the most powerful tool to prototype. Stop going into Miro. Stop going into the wireframe tools. If you go to my website, I changed my simplified innovation model. It used to be assess, build, and iterate. Now it is build. We just build, right? And pretty much is iterate, right? And so with vibe coding now, it's easy to go in, use natural language, tell that tool, build me this platform. Take that platform, you start to show it to a few people, and get some background information on it. Now, here's the thing that most people won't tell you. The first thing is, well, I'm going to have them sign an NDA. I'll talk to you all day about what I'm building, why I'm building it, where I'm building it, what I'm using it to build, who I'm getting my staffing from. I'll give you the whole playbook. Good luck executing it. I'll execute it faster than anybody else will. And so people get nervous about talking to investors and talking to other people about, well, if I give them too much, they're just going to go and compete against me. If they wanted to do that, they would have done it already and stopped not wasting time to talk to you in the first place. And so it's the execution that's the most powerful point. So go into vibe code your initial app. Now you have something to talk to. Now you have something to talk about, right? User experience is not about your passions. And this is one of the number one next biggest problems that I help people understand and face. Is a lot of people are passion driven in their business. And I'm like, that is powerful. That is wonderful. That is amazing. That is a nonprofit. And then for the other half of the people, I'm like, yo, that touched my heart. That hit me here. That is a business as a hobby. Right? The number one next thing you need to do is talk to somebody who can advise you on, is this a scalable, marketable, investable company? Now, I'm going to tell you something that everybody else won't. For those of you thinking about going and starting a company, starting a business, going out on your own, don't leave your day job. No matter what they tell you, and if you're going to talk to a studio, an accelerator, a venture studio, an investor, and one of their requirements to invest in you is to quit your job, run. Right? If you haven't already made up in your mind that you have enough savings to cover yourself for not one, not two, not months, years, it's not time yet. I was talking to somebody else, was it last night? Was somebody in here last night about not quitting your job? Oh, he's not. Is he in the room? He's not in the room. Yeah, he's beautiful, smart young man. I met him back at Meta. We're doing these Black in Tech. I don't know if you guys heard of Black in Tech. A couple years ago, we had a Black in Tech here in Seattle. Everybody had one. Amazon had one. We had one. Microsoft had one. And he was in a hackathon. So proud, young man. Went nuts working for Google. Been at Google for a number of years. And he's talking about having these ideas. I'm like, the first thing you need to do is stay in your job. Right? Venture capital, raising a company, going after venture capital is not the fastest way to get wealthy. Oh, it got real quiet. It got real quiet. Launching a startup is one of the most expensive and riskiest financial decisions you can ever make. The best way to do that, the best way to build that is just like they do for SMBs. I don't know, is this valuable? I don't want to be standing between y'all and lunch if this is not value. So the number one, the best way to launch a business and the best way to scale a business is first having the time to understand what you're building, why you're building, and your why. I'm going to pivot here in a second. What are you next? What's your idea? Hold on, I'll give you the mic. Oh, she's got it.
Appreciate it. It's peer-to-peer sports matching for the purpose of finding community to play with, or the ultimate goal of being able to bet against the people that you're playing against.
Peer-to-peer betting. Well, what's the people you're playing against?
So pick any sport, say meaning you want to play a pickleball game, for instance. I mean, you could match on the application, find a pickleball game, and based on our performance, we can get a payout depending on what we want to wager.
Okay, so Mark and I are going to Top Golf. And I'm going to bet Mark that my score is going to be 300 points more than his. We go into your app and we set up the rules and we pay you the money as the
broker.
As a broker. And if I win, I get the money, Mark loses his money, and you get a small portion of the payout.
Exactly.
Awesome. How far along are you in your building journey?
We have the MVP that's almost ready, and we did a beta test. Well, I've done some beta testing on a previous iteration for basketball. We initially thought that the users wanted highlights. The users wanted a platform to organize on, but they wanted highlights and they wanted some monetary payout. So that's when we realized, and we switched the platform from just one sport to multi-sport.
Awesome. So, okay, the next thing we'll talk about is traction. How many heard of traction? Traction. What do you think traction is the real definition of traction? Stickiness. What does stickiness mean? How many people use it? That is not my definition of traction. My definition of traction is how many people will buy your product and pay the renewal. See, one of the things that they won't tell you is a lot of these startups, like, first off, let me just say this, and I said it before and I'll say it again, and y'all can be mad at me if you want. LinkedIn is not real. LinkedIn is a platform for hype. Now, I'm overgeneralizing. There's a lot of cool truth tellers in there. There's a lot of wisdom you can gain. But almost most of it about startups is not true. Because you start getting on the phone and Zoom calls with them, as I have, you start asking clarified questions, as I have. And I said, okay, how did you really raise $4 million in ARR in your first year? You do understand what ARR is, right? Yeah, we raised $4 million in ARR in our first 8 months. I'm like, the math ain't mapping, bro. Like, a year is 12 months. So what's your real monthly recurring revenue? Oh, well, we just got lucky in March and we got our $8 million. I'm like, that's not ARR. Well, how long have you been trying to raise? 6 months. bro, you got no traction. Right? So, but the number one thing about traction is not just who you can sign up the first time. It's when that renewal comes up, how many people are going to stay signed on? Churn is the definition of how many customers you lose at the time that they're supposed to pay again. So if you have a monthly recurring contract or subscription that has a 12-month cycle, you're expecting to get those 12 months paid, provided that their payment information doesn't bounce. And you're going to get those payments over 12 months. That's 1 year ARR revenue, annual recurring revenue, right? But the real number is what happens on year 2, what happens on your 13th month. And that is when things fall apart. And so that's why most small businesses project out 3, 5, or 10 years into the future. Because you're not really going to make the money back to pay yourself for the money you invested in for X amount of years going forward. And how many people know that most small businesses, most startups are not profitable from the start? So when you're talking about customer experience, when you're talking about building for scale, you're really trying to get down to what do I need to do? What product, what service do I need to provide? What customer support do I need to make available so that when it comes to renewal time, they'll pay for that renewal. They'll still see continual value. So when you're getting down to how do I define customer experience, it's the why, and it's the strategy, and it's the roadmap that goes past that first year. How many people building their product or their service have a plan past their 12th month? I see 1, 2, 3, 4 hands out of the room out of 40 of the ones that raised it up 4. This is what they don't tell you. And the number one thing, the number one resource that we have, I was talking to somebody last night, I said, you know what? And Mark, I would never do this, but I was like, what would happen if we split this room into each corner and asked specific people with specific subject matter expertise to go to a specific corner, and then ask each corner to talk to somebody in all the other 3 corners, at least 3 people, and give at least 3 people their contact information? What would happen?
Be quite a few startups that may be formed. There might be a few startups formed in this room.
And my thought is your greatest resource for your idea, for your investment strategy, for your business, for whatever you're planning for your future, your prosperity journey is likely in this room right now. How do you build for scale? You don't go at it alone.
So, quick note, you probably remember this. Remember the company Rover by Greg Gottesman at Pioneer Square Labs? That company was started at a hackathon event for Seattle Tech Week. And then that company went on to be a publicly traded company. And then also recently had an acquisition that was bought out for, I think, a few $1 billion. But it all started at an event, something like this.
So building for scale, customer experience, what's going to get customer to pay or renewal? What's going to keep you to avoid churn? What's going to help you understand what's coming forward? What's going to help you understand what's coming next? Isn't necessarily, and I know it's contrary to everybody that everybody says, but having your own advisor, your own friend, your own mentor is the single most valuable thing that you can do for your company and your progress. And that's what I call foresight. The ability to ask somebody questions that's going to tell you what's coming next, 5, 6, 12, 18 months in the future. Help you navigate around the mistakes that most people make, that you're more likely to make. How many people also know that a lot of successful people you see on LinkedIn and celebrating about their raise or their exits, that was not their first company? Failure is the path to success. The journey is not linear. Right? Is this helping? All right, I know that there's lunch coming up next, so I want to take some. Oh, sorry, we got one more speak, but I want to take some questions because I really would rather prefer to address real-time questions then continue to give you solid theory. Do we have time for 3 questions, 3, 4 questions? Oh, I like that. Asset over liabilities.
So in the beginning, you mentioned like vibe coding. So my question is very simple. Like, what are some of the better tools that you suggest utilizing as far as like creating as efficiently as possible?
Okay, so I'm a little older than Mark. I'm a little older than Mark. I'm a little old school. And I would tell you, I can put a real developer, like a real principal level developer, against a person that, you know, went through boot camp, maybe straight out of college, start vibe coding, and I can build a better product in 24 or 48 hours. Now, I'm not saying you should vibe code, so I'm old school. So that I'm gonna say that to say, I don't know the vibe coding landscape, but I do know a lot of the students that I mentor, both Ivy League and non-Ivy League, but primarily Ivy League students, it just happened, typically prefer Cursor, Replit, Lovable, those types of tools, right? But what they don't tell you is that is their front end. Their back end is generally still really hard-coded in Python or Ruby or whatever the tool that's best suited for what they build on. So what people really don't tell you is most often, so vibe coding is a perfect way to get your idea to market, to get it validated and to get traction. But it rarely is going to be suitable for the next 3 to 5 years to actually put for anything that can scale. The reason is because when they trained models, when they took all this, does everybody understand the basics of training an LLM? Okay, I didn't see nothing. Okay, so the quick, very dirty, dry way of overgeneralizing what a large language model is if you took a bunch of, how many people remember those Merriam-Webster dictionaries and the encyclopedias and the libraries? All right, so you basically take all the books in a library and throw it in this meat grinder, this chewing up agent, this kind of like, you know, chews up the little tree limbs and kind of mushes it all together to create like mulch. So basically what an LLM would do is take all of those books, read them all, read all that data in, try to organize and match it as best it could. And then a human comes in and says, okay, here's how you kind of perfect these data kind of matches together. This data references that data. And so you now have a pattern matching system. And a lot of times what happens if it's with faces or it's with objects, a human being is clicking on a button to say, yes, that's right, that's no. And it does that over and over and over time, and it gets to the point where it can recognize patterns, and it can recognize patterns that are like patterns, that look like patterns. So basically, it can say, hey, he's wearing a lanyard, but the version 1 said they're wearing something around their neck. I think it's a necklace. No, that's wrong. Oh, it's wrong? Okay, what is it? It's a lanyard. Okay, it scans it again. Oh, I think this is a necklace, or it could be a lanyard. Okay, nope, that's a lanyard. Okay, it's gonna scan, ran it again. Okay, now I think that's a lanyard. Okay, but what color it is? I don't know, because I don't know colors. Okay, here's colors: red, yellow, blue, green. Here are these colors. Now run it again. Okay, now you run it again. Now I understand it's a lanyard and it's red. And that model is basically an algorithm. It's a mathematical equation. It's literally math. And it's just like complex mathematics with a bunch of different variables, X, Y, Z, etc. Then when you put in a number of those variables in, that language model then understands and reads back what it is, right? And so that's what an LLM. So to kind of address it, those are the normal tools to use, but consider that your front end, use it only for you're getting your traction, but you're generally gaining traction at the same time you're building a much bigger back end. Now, I advise everybody to stay vibe coding on your front end until you start to reach hyperscale. Because the front end is all about who's coming to my site, do I understand who they are, funneling that back into your sales and marketing pipeline, and then actually scaling that up. So you don't want to go too hard into a hard-coded application too early in your cycle because you can't pivot. The power and scale is how quickly, how easily, and how effectively can you pivot. The faster, the easier, the less disruptive your pivot, the faster your revenue gain. That work? There's one more. Any more questions?
Jimmy, how you doing? Michael Bayless. Quick question about when you're vibe coding. Can you talk a little bit about the deployment and then the security on the back end?
Oh, sure, absolutely. I thought you were talking about the security on my website. I was like, it's horrible, it's Squarespace. Okay, you're talking about security. Okay, that's easier, much better. Yeah, so vibe coding. I've written articles about this, and the theory, the context around why vibe coding is not secure right now is because when we trained it, I kind of went through this long-winded explanation of LLMs. We're not going to do that, right? And so when we trained the tools that we call vibe coding to produce code, we trained it on code that was inherently insecure. So even ChatGPT-5, I don't know what Gemini's on, I can't keep track of Anthropic, right? Or whatever versions they're on, they're still their core and data that they were trained on was trained on code that engineers were writing were insecure. It is my personal opinion that the only reason cybersecurity exists is because we didn't have the foresight to build more security and privacy into baseline infrastructure and how it operates today. We didn't know that people were going to weaponize it and turn it into a weapon and do all this malware and all these viruses and all these attacks. And so because we didn't have that foresight, we never thought that we had to protect this baseline infrastructure because if you remember, it was originally created for military, government, and education. It wasn't intended to be commercialized. Now, people like myself who are working for some of the big Magnificent Seven companies and some others that are think tanks not to be named, like we've had access to AI for a long time. AI is now just going mainstream because the cost of operating AI with the advancements that we heard all about NVIDIA yesterday is now at a low enough cost point that the general population can have access to it. So you have all these competing things happening at the same time. And so the reason why it's insecure, and it will be insecure for some time, is because now it's got a little bit of intelligence in AI. And now we got to go help it understand that the code that it wrote is inherently insecure. And we have to retrain it on how to write secure code. But the problem is only now are students coming out of college fully equipped to write secure code from the beginning. So now we have all the older people, all the gray hairs in the room, right? Who now have to try to figure out how to train all the engineers in the middle, how to write secure code so that they can assess and verify what's being produced by AI. So that's why vibe coding typically, if you got a vibe code, you got a vibe code. Let's be honest, we don't all have resources to go hire the right kind of engineer who can compete against vibe coding, right? So your next step would be vibe code it, and then hire somebody, ideally somebody who's been vetted, trusted, that you can verify. Whenever you're doing tech, whenever you're doing business, I think my friend always said my two #1 words, especially when I'm hiring, is trust but verify. Trust but verify they have the proper security skills, and then ask them to work for about 20 hours max and provide you an assessment of security on your application. A good report that from the security person should not only include problems, should include quotes with line items in the code for what's incorrect. Now, the good news is some of the GitHubs and GitLabs and other tools of the world are trying to catch up. And there's a decent possibility that if you fed in your current code, the proposed code, you can ask it to improve your code. It still won't be perfect, but now you've only paid for 20 hours, ideally somewhere between, I'm going to just tell you what it costs, somewhere between $85. Well, it depends on where you are in the world. If you're on the West Coast and the Northwest, it's going to be between $85 and $150 an hour. If you're on the East Coast and ideally not New York, you might be able to get away with it somewhere between $45 and $85 per hour. It's just the reality. You can also get this. There's some excellent talent that I'm learning about. You might know about it now coming out of Kenya, Nigeria, and Uganda. Instead of just going to Uruguay and South America or India, that are really talented individuals that are super low cost, that are super security trained, our cousins, there would be a great resource as well. So vibe code it, get somebody to give you a review. There are tools out there that might work, that might not work, but it doesn't replace a security engineer. pay that little bit of money for the security engineer, feed that report in and give them an example. Ask ChatGPT, ask Gemini, help me build a proposal format or an example report format that includes code snippets, line items, and examples of how the code should be improved. Before you sign the contract, include that in the contract. Do not pay all fees up front. The best way to deal with, oh, I need all my fees up front. I'll pay you a third. I'll pay you the second third on the readout. I'll pay you the final third on delivery. So it's the weirdest thing in the world to me why somebody will hire a plumber or an electrician or a carpenter or a drywaller. They won't pay them all up front, but it comes to tech. Awesome. That answer your question? Are we good? Any more? We're about time. Awesome. I hope this was helpful. If you have any other questions, I'll be around the rest of the day.
Thank you so much, Jimmie. We appreciate you. Everybody give Jimmie a round of applause. All right. All right. So I know that he accidentally mentioned lunch. That comes after this event. So you guys can go in and eat at the perfect time. But would you rather go eat or would you rather experience the power hour of the market and get like, y'all want power hour? Y'all want power? Y'all want? Hey, look, we can go to lunch. Hey, I'll see y'all later. Power hour? All right, let's do it. All right. So I'm really excited for this because, you know, a lot of times people look at it and like, especially within like, since the Black financial literacy space like literally blew up or FinLit space blew up. And it's kind of like, okay, hey, well, you know, you hear from one voice and it's like, that's it. I've always learned that, you know, listening in and like hearing different perspectives. And, you know, I always believe that all different perspectives bring significant value and also just well-round your thesis. So I thought that I was going to do that in this year's summit, and I felt like that would be a treat. So this year, I invited 3 traders across various different backgrounds to come and talk to you about some of their favorite trades, give you some of their advice, what they see, what they examine within the marketplace, to help each and every single one of you that are still in your trading journey or within your investment journey. So can we do that? All right, so this is exciting. So I'd like to introduce Alaina, Mo, and Lawrence on this wonderful stage. So today we're gonna have a fireside chat where I get to sit back and I just get to chop it up with my traders, and you guys get to see how is it that we discuss. So come on up on the stage and join us. Give them a round of applause. We got Alaina, we got Mo, and we got the shining suit in the back. We got Lawrence. Okay, bro. How y'all feeling? Okay. All right. Well, you know, take a seat however you guys feel comfortable. All right, we're gonna go wired mics so that way we get no feedback. So I hope you guys enjoyed this session. Oh, I get that. I guess I gotta keep it. Do we need another? Okay. So all right, so I'll take that one. And I'll hang tough on wireless over here. I'll try to stay clear from you guys so that way I don't give you guys too much feedback. So are all 3 of the wired mics live? Just go ahead and tap it just to make sure. All right, they're live. Okay, so here we go. And on top of that,
I don't think that.
speaking to it, like,
Hello?
yeah,
Oh,
okay, yeah, you live. Live and in color. All right, so we're gonna go down the line. Introduce yourself. You know, how did you get into training? And also, well, I'll get the other stuff out of the way. So starting off with you, Lawrence, like go ahead and tell us about yourself. What is it that you do? What is it that you trade? Oh, also, we're missing another trader, by the way. Where's Moody at?
Yeah.
Oh, come on up here. Look, see, this is what happens when I hit 40. This is what happens. This way. Hurry, 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 hurry. Yeah, give him a round of applause also. Look, I don't want none of my traders to be remiss. Ooh, here I am. I'm so excited. I'm over here forgetting letters and stuff. Welcome to the stage. Is there another mic or? Okay, well, let's go with the second wireless. I just have to stay away. All right, so first, then we're gonna start off with Moody. Tell us about who you are. You know, how did you start your trading journey, and then also, yeah, but we'll start there. So for the sake of time, go ahead.
So my name is Moody Bugs. I'm from the Bronx, New York. My trading journey started in 2021 of January of 2021. I was looking to build my beauty supply store. Why? Because I'm for my people, and I believe that we need to invest into things as well that we primarily use every single day. I know we're talking about tech and investments right now. However, we're the ones going into beauty supply stores. And my cousin was like, hey, I'm trading options. He was making $1,000 like every other week. I was already invested into the stock market. I knew nothing about options. I didn't know how to read a chart or anything. So I came into a group just like everybody does. I started trading, I started learning. I was able to retire my job in the first 3 months. And to be honest, I don't think it's because, oh, I'm just the best trader. I think it's because I failed a lot on a lot of things and I just was very passionate about it. From there, I started to teach. I started to learn a lot from Mark Monroe. And one thing that I learned from him is that he wasn't selling a subscription or anything. So I just partnered with different people and just like worked and taught them how to trade. I'm a price action trader. I'm very confident in what I do. I do utilize the strat. However, I think it's important to just utilize the reversal patterns and look at the market structure and know how to trade. I trade futures, options, and cryptocurrency. Right now, I'm more so invested in cryptocurrency as well as scalping and day trading futures while I'm swing trading and leaping options.
Hey, we got the Panther in the building.
Yes, sir. So my name is Lawrence Eccleston. I'm originally from Long Island, New York, based in Atlanta now. I really got into trading when I was in high school. So I started pretty much when I was 16, almost 10 years ago now. For me, it was just about controlling my time. I knew when I was in school that like just going and getting a 4-year degree wasn't the only thing that I wanted to do. It was big for me to take a bet on myself, me coming from the background of being adopted, having my mom, she was struggling. So I got my first job at 15. I wanted to be able to provide for her. So that's really what got me into trading was just from the ability to control my time and then also build my capital. I spent a lot of time around people, kids who had more than me. So it was always, I was like the last one to get the car, last one to get a lot of things. So for me, that was where my pain points hit. But I focused on just developing myself as a trader and investor because I knew that if I was able to invest now, that it would benefit me in the future, which obviously it did here today. So that was really my focus point. Once I went to school, I knew that just getting a college degree wasn't going to be enough. You needed to have your dollars work for you. So working from 15, I was like, nah, I can't do this. Then getting a second job, just getting a second job at 17, I just focused on keeping my liabilities low, but being able to invest more. So for me, I just wanted to spend as least as possible. I used to be like Julius from Everybody Hate Chris. I could count like how much I spent, how much dollars was in my pocket. Like I kept track like that. And so for me, it was motivation. I started trading once I was in high school, and then once I moved to college, that's when I took it to the next level. So I didn't go to no party, but didn't drink, none of that. So I focused just on grounding myself. My strategy, initially, I was more of a day trader because I kind of had more time. So when I was in college, I would day trade and then do a little bit of swing trading. What got me into being primarily a swing trader now, usually I look to hold a position with expirations anywhere between 2 to 9 months, expo, set a couple targets, look for high probability setups, bull flags, bear flags, double tops, double bottoms. I look for all of those things. So that's my primary strategy that I go to. I sell cover calls as well as cash secured puts. So I'm on the buy and sell side, primarily only really trading options. I don't trade futures or anything. So that's pretty much just my strategy on how I got started. I started teaching 2018 in my dorm, focused on just teaching my friends and my family and those who showed up. And then they say, oh, well, you're really good at this thing, teaching me. And so then I continued to teach them. Next thing I know, I was hired by my university. So I started teaching. That was my first time teaching, was teaching my peers and my students. And I seen the level of success that I had in it. And then I started hosting classes and seminars. And here we are today. Been on a lot of different platforms, been blessed to teach a lot of people on impact. And this is really my passion. So I'm blessed to be on the stage with everybody. It's the first time meeting some people in person, but I have respect for everybody on the stage. I appreciate being here.
We got Investing A in the room.
Hey guys, can you hear me? Okay, so I'm Alaina. I came across the cousins. Oh,
Speak it to the mic.
can you hear me? Okay, cool. Sorry, I'm nervous, you guys. But yeah, I came across the cousins on Clubhouse back in 2020. You all move as a unit, so I came across a lot of you at the same time. And yeah, I am a day trader. I feel like that title gets a lot of mixed reactions, but I do it with it's sparing, right? It's sparingly. So I trade maybe 2 to 3 times a month. Very big on like macro geopolitics. But I also take more of like a psychological approach to the markets because there's more than one way to make money. There's more than one way to trade. There's so many strategies. And one thing I learned is that a lot of traders have the same problems. A lot of traders run into the same issues. And so like, can I do like a quick little vibe check? Okay. So like raise your hand if you day trade. Okay. And then keep your hand up if you've ever lost money on a day trade. Actually, let me say that.
That's
all right. All right. No, keep it up. If you've lost money on a day trade, keep your hand up. Okay. And then how many of you went back into the market to recover that money the same day? Yeah. So this is like my jam. Like this is what I wanted to find out about traders is like, what is it about us? We're human, right? It makes us bad traders. And so I like to teach people how to think, teach people how to manage themselves. So you can go out there and make the money however you make it. But most importantly, you can keep it, So yeah.
That's lit.
Yeah.
And then we got Mo in the building.
Hey everyone, my name is Mo Suri. I'm from Vancouver, Canada. In 2020, I took a big loss on a business. I'm pretty sure a lot of people had brick and mortar businesses that went under. I had the same thing. And what got me into options was greed. And I saw someone post a picture where they made $50,000 with $500. And I don't know why I thought I'm going to do the same. And so I looked at myself and I'm like, okay, I've done multiple businesses. I worked corporate for 9 years and I'm not happy. I knew money didn't make me happy, but this much money, maybe it'll make me happy. So that's what got me into it. And once I got into the market, I started making money. 2020, everyone made money. Like, honestly, you had to try not to make money. That's how easy 2020 was. So started making money. And what I thought why I was making the money was talent. It was pure luck. And so when the market pulled back, everyone that I knew gave back everything. So most people left. Others took loans against stuff they had and lost more. And what I did was like what anyone does. I wanted to learn more. And the more I learned, the more I overanalyzed. And what I realized is trading isn't really about strategies. It's about mindset, like anything. So I started working on mindset. I read a book called Trading in the Zone. How many people have read that book?
Solid book.
That changed my life. So I got into day trading. And day trading to me was like gambling. I got addicted to it. And again, I had to, relook at what I was doing, and I call myself a professional loser because I've gone so good at losing now that I have no pride anymore. I have no ego, and I want to be so humble because every single time I thought I knew everything, something would happen in 2020. And then 21 came, and then 22 came. I learned every single month. And what I realized is if you're not calm in your mind, no matter how much you know, you're going to do the same thing over and over and again. So I personally don't day trade anymore. I swing trade because it keeps me easy, cool. I want to spend time with my kids. For me, it's not about money anymore. It's about spending time with family. That's all I care about. And helping people in the right way. I realize that I can't help everyone. There's people that want to day trade. There's people that want to scalp. I'm basically a swing trader that focuses strictly on structuring the trade with risk management. That's all I care about. My goal is to know exactly how much I'm going to lose. Winners, everyone can manage. Most people are very bad at managing their losses and they look for strategies. It's not strategies, it's emotions. Most people are wrong. They don't want to be wrong again. So they hold the trade and they lose money. I'm basically looking at supply, demand, institutional flows. That's all I watch. My watch list is mostly what the institutions are buying. And based on risk reward, I take my trades.
Nice. So as you guys can see, we put together a pretty solid lineup. Do we agree? Yeah. All right. Okay, so let's get into it. What is it that you notice as it pertains to bad traders?
Bad traders, they don't learn from their mistakes. They keep repeating the same mistakes and they tell themselves this is cost of doing business. Every L is a learn. It's not. You keep doing the same thing over and over again. It's insanity. So that's what it is.
Anybody else?
I would say a lot of bad traders don't know that they're bad traders. Self-awareness as a trader is your edge. And so if you're not self-aware, that's one thing I would challenge everybody to really work on. But yeah, I think that's a big thing. A lot of them don't realize that they're bad traders and they don't have anyone to hold them accountable because it's just them and the buttons, you know?
Yeah, I think just going into I think what sometimes I see from a lot of bad traders is just thinking that every week is going to look the same. Like I always say there's different parts of there's different times in the marketplace when there's a lot of volume and volatility. But sometimes we think like that we're going to show up every day, Monday through Friday, and there's always going to be an 8+7. But that's not really the case. That's why I think setting alerts is super important. Mo touched on something huge, and that's having time. Like you trade not to make it a 9 to 5 again. You trade to spend more time with the people you love because time is really more valuable than money. So I would say like bad traders don't treat it like structure. Like if you put a game plan together and then you execute, but then you find you get in the middle of the game and you get happy feet. So that's what I think happens a lot of times.
Nice.
I'm gonna keep it simple and raw. Bad traders, y'all talk bad to yourselves in your minds. Y'all like, oh, I'm ugly. And I'm just gonna keep it simple. This is what you do. You go into a trade, because I was like this at one point. You go into a trade and you think about your last loss, right? A man is what he think of success. Think of it's going to be profitable, right? Know where you want to dollar cost average again into, right? That's day trading or scalping. You can't just go into the market and expect, oh, some people say it was a bad entry point. I don't believe in a bad entry point. You know what I'm saying? It's the market structure. Maybe you entered in right here because you thought that it was going to break out or whatever the case may be, or it was a reversal pattern. And you have to allocate more money to it, right? Buying more contracts and things of that nature. And it's all about mindset, really.
Okay, so I'm going to turn up the heat a little bit, okay? So a lot of times I hear a lot of beginning traders talk about indicators. Do you care more when you're looking at a chart? Do you care more about the indicators on whatever trading platform that you're using, or do you just read the actual chart itself?
So in my opinion, risk management is your biggest indicator. and most indicators are lagging indicators. So a chart will tell you what's happened in the past. It won't tell you what's going to happen next. So that's why I always focus on, if I'm right, how much do I make? If I'm wrong, how much I'm going to lose? That's the only indicator I look at. And if that's good, then I'll throw moving averages or look at key support. But my basic indicator is either watching flow, who's buying what, who's selling what, or managing the risk.
Oh, sorry. Okay, so I would say I'm more so price action. I love price action, and it really tells the story.
Can you define price action?
Yeah, so the candlesticks, the volume, that is, if you think of it like an ice cream sundae, this is how I explain it to people. The price action, the candles and the volume, that is your ice cream. That is your base. Most people are okay to go sit down and have a bowl of ice cream. They don't need the toppings, you know? And so the indicators, that's your sprinkles, your chocolate syrup. It makes it better. It makes it clearer that it's a sundae, but you don't need that. And I do use indicators, don't get me wrong. But you got to be able to read price action, because that's how that's what your indicators are confirming, is the price action.
I would say that when it comes to indicators, I think when most people come in, like I remember in 2016, 2017, you start off with like basic ones like RSI and MACD. But I think as you start to develop your trading process more, you realize that those are unnecessary, right? So like for me, I don't use really any indicators when I look at a chart. I was just speaking with Ms. Hopkins outside, and I start with a macro level type time frame, like the weekly or the monthly, and then I work my way down. The first thing that I do when I open up TradingView is I look to see, is the stock making higher highs and higher lows, or lower lows and lower highs. That's the first thing, determining the trend, and then determining what phase that it's in. So is it in public participation, accumulation? Is it in distribution? So what he said is so important. Like every indicator, like the MACD could cross two time frame you're looking at, but the MACD could cross 2 weeks. And now the stock is starting to turn up like 2 months ago. So it's like you can't really use indicators, because price is going to be your number one story. So to me, it's about setting levels, identifying a trend. Higher highs, higher lows, uptrend, lower lows, lower highs is a downtrend. And then paying attention to what phase that it's in. If it's in distribution, it's going to be hard for that thing to recover. If it's in accumulation, you got to understand that there's not enough volume there to, take off. So, I mean, look at a lot of the equities that we speak about today. You pull up Palantir's chart, just using them as an example, they sat in accumulation for 2 years. So you need to use more phases and more trends analysis before anything.
For me, I utilize indicators. I utilize the RSI. I don't think it should be the first thing that you should try to utilize. I think it should be price action. The way I look at price action is opening, closing, high and low. When I say price action, I'm talking about one candlestick, right? And your opening price is your support, right? Right here. That's your support. Your resistance is going to be the closing price. Your rejection zone is going to be the highest point of the wick. Your bounce area is going to be the bottom of that wick, right? And then when you have the right terminology while you're utilizing price action, it's easier to trade. I think indicators are great if you study them and you learn them very well. The only indicator that I utilize is the RSI.
Okay.
Can I say one more thing?
Go ahead.
I'm gonna give you a gem with that RSI. In 2021, I left it regular how it was. I think the low was 30, then you have 50, like the medium part, then you have 70. I changed it to 75 and 25 on the lower end, because I'm a day trader and I'm a scalper. And one thing that I can tell you is, from the point, and this is for any time frame, if you see your RSI at the bottom of that 25 mark to anywhere between the 50 mark, you're in a downtrend territory. It will fluctuate as long as it rejects that 50 and keeps going down. It will fluctuate down. You're in a downtrend territory. Whenever you get to the 50 mark to the 75 mark, you're in an uptrend territory. So if you see that you're overbought, just wait till you come down to that 50 mark and utilize the tweezers bottom or Morningstar to get into that trade.
Go ahead.
Can I piggyback off that?
Go ahead.
Okay. Cool.
Just make sure you guys raise your mics.
Okay. Yeah. So I was going to add, because I have like a little special thing with RSI too, but traditionally RSI, it's telling you whether a stock is overbought or oversold. It's an oscillator. And essentially we are looking at it as because those are emotional things, right? Overbought super bullish. Oversold is very bearish. So it's sentiment, you know? So we use it as a sentiment check. And typically, like if you look at NVIDIA on the daily, like that run up, the RSI literally made history, right? We hit like what, 96 or something. And so, you know, just because we got over 70 or, you know, even 80, it wasn't necessarily time to sell. So it's just really important to tie your price action in with your RSI so you get the full picture of what's actually going on. But yeah, I just wanted to add that.
Yeah, I want to add something since she said as well. So one thing, you hit it on the head. It doesn't matter when we're overbought and we're over the 70, especially looking at a daily. The reason I'm telling you that that's a higher time frame. What you'll want to do is go to a 2-day, a 4-day chart, maybe a 15-day chart, and see how overextended it truly is. Because that's just a daily chart. What I want women and men to learn is utilizing those time frame, having multiple time frame analysis is going to change the way you see the chart.
Okay, so speaking of charts, and feel free if you guys have your phones. So the chart of the day is the S&P 500.
Yes.
And so we're gonna play a game. We're gonna play a game. And so for those that are watching virtually, just put on the SPX or SPY, however you go. I want you guys to look at the charts on your devices, and then we're gonna ask the traders, where do they think the S&P 500 is going to close for the day? Where do you think it's going to close for the day? All right, so take your time, and then walk us through the process as you're like before you give your number. Walk us through like how is that you got there, so that way people can understand like the thought process as a trader. Does that help everyone? All right, bet. Now remember, it's not a foolproof science here, so like. All right, so
ready?
Yeah.
All right, so I'm in the West Coast, so I got to remember, I think we close at 1 p.m., right?
At 1 o'clock.
So right now I have a structure, and I'm on a 5-minute time frame. Why? Because the market's about to close pretty soon. I have a structure at 6,652 and 61 cents, right? We can potentially come right back down there. I feel like we're going to close above 6,657 and 13 cents. And why is that? It's just it broke highs again. We have a new structure, and the structure is the first number that I gave, which is 6,652 and 61 cents. That is going to be our main resistance at the point of the price action right now is utilizing that as support.
Okay. Alaina?
Oh, I'm thinking, well, barring no catalyst, you know, no news or anything.
Yeah, no news in bar.
I would say maybe 66.50, maybe a little profit taking before the weekend.
Okay.
But yeah, they like to pin that thing.
Okay, go ahead, Mo.
So today's quad witching, and one of the key characteristics of quad witching is we get pinning action. We usually pin on round numbers. So 66.50, 665 on SPY, that's what I'm watching. I expect a whipsaw action in the last 5 minutes. That's usually what happens when they're rolling contracts.
Lawrence, what you think, bro? Your mic.
So I was gonna say, it looks like right now, for one, this morning we pulled back and we made a DB. I'm on the 30-minute time frame.
Okay.
Right there at 660. So you shot over the neckline over 662. So I see kind of the same thing around like 665. Similar to what Mo said last. So it's about to be 33 minutes up to close. So I think that we'll get a little ping pong action towards like the last 5-10 minutes of the day.
Okay, I'm gonna just take a shot in the dark. I'm gonna just say 6656. Okay. All right. So we're gonna come back to that one. Everybody heard the numbers, right? We'll come back to it. Huh? Which one did I say? I said 6656 for the SPX. All right. So look, They'll probably be more accurate than I am. They were literally looking at.
I'll just say we're going to close at all-time highs today.
Yeah, there you go. So. Okay, so speaking of which, oh, go ahead. Sorry.
No, I just said it moved 30 cents since I finished speaking.
Oh, that. All right. So speaking of SPX, so we just had this astronomical V-shaped rally since April. Now we find ourselves in a Federal Reserve rate cutting environment where we just cut 25 basis points. So walk me through like what you guys are thinking, you know, and then of course we're hearing chatter about 2 more cuts, which would put us at the end of 2025 at 3 rate cuts. So walk me through your thought process as traders. You know, what's going on through your mind as you see this market out of all the things that we've seen in 2025? What's your perspective?
So the market is forward looking. We've been running because, you know, Trump's been talking about cutting rates and we're finally getting it. Part of me thinks that do they sell this news? Because the market has been running. Now we're also seeing countries for other stocks like China running as well. Does the money now start moving in from NVIDIA into that? The second thing that I read by, there were some notes by Goldman Sachs, and they talked about how a lot of funds are chasing stocks because they need to at least match the performance of SPY. So what they're doing is they're buying small caps. So you're seeing all these low float stocks going because they're trying to make up for the performance. So I think a lot of money is moving there. An example is Open. I think everyone knows about Open Door. That's running. I saw a whole bunch of flow on Snapchat. And so I think they're just chasing at this point because they want to close the year green. Personally, like as a trader, I don't like to predict because when I predict, I have a bias and that's how I start trading. I'm mostly reacting or following the flow. My own portfolio, I started taking a lot of profit this week because I expect a big pullback. And I'm probably going to start adding puts for October because hedges are so cheap. You add hedges when they're cheap, not when they're expensive. So at some point, I think they're going to sell this news and I'm ready for it.
Oh, say that one more time because I heard a few news in the room. So say that one more time.
I'll add something to it. You should always take profits when you want to, not when you have to. And you should always add hedges when they're cheap. Right now, you can get October SPY puts, IWM, QQQ for so cheap. They're hedges though. If you're a small account, you could just chill. You don't have to trade every day. That's the problem. And you don't have to predict either. So you could just say, I don't know anything. I'll let the market tell me. But that's where I'm looking at.
Next.
I think he has it.
We're not even there yet. But since you already raised your hand, go ahead.
Can you speak to that from the option? Cheap, that means that the market. So what you just saying is, if market what does that mean? Why did it buy?
So hedges are for a certain kind of traders. Let's say you have a lot of stocks and you want to protect yourself. Best way for small accounts is just start taking profits. It's not to buy puts, okay? Because once the put starts losing value, they'll freak out and sell. And puts hedges are like insurance. You don't want the insurance to be used, right? That's why they're called hedges. It's not a play, it's a hedge. Second thing is you need to watch VIX. It's going to tell you what the volatility is doing, right? Are they buying puts? Are they not? I think we're still around 20, which means that the IV on those October puts is completely destroyed. And if you go look at the premium chart, October puts are probably lost 80% of their value. And in my opinion, and I'll say it here, I think we're going to get a 100-point drop next week. In my opinion, not financial advice. If that happens, those October puts are going to go up 100%, even though they're a month out or whatever, 3 weeks out. I think because the IV is so low, the moment we get a big drop, people are going to start rolling in those puts.
Anybody else on this question?
Yeah, I would say real quick. So I would say historically, correct me if I'm wrong, but I believe we typically have seen recessions like 8 to 11 months after rate cuts start. And so, yeah, I'm definitely getting more defensive, less exposure on like the day-to-day side. But yeah, I'm looking into, out of tech. We've covered that yesterday, but yeah, just the more defensive positioning and just protection mode. I think it's really important to come off of offense when it's time to come off offense. And we've got some crazy high valuations right now. So it's running hot for sure.
Lawrence?
So to even touch on the implied volatility question that was asked, you start to see, once again, you start to see a lot of the volume on the call side. And so those puts, pretty much the volume is pretty low. So what he said was super important about hedging. But being mindful when you do hedge. Another way of hedging is to start looking to sell some covered calls as well. So you own 100 shares of a company, you start to look to sell some OTM options out the money, some with a 1-to-1 delta to theta ratio. So when I say 1-to-1, the delta may be 20 cents and the theta is 20 cents. So that way that the time decays, so that's just another way for you to be able to hedge just when that pullback does happen, that you're actually able to capitalize a little bit off it as well. And then as far as to the original question, looking here, kind of as far as like what sectors am I paying attention to? Healthcare is one that's been beaten down pretty bad. A lot of rotation out of UNH. UNH ended up hitting a yearly low of around 237. Ticker Novo dropped as well. Both of those stocks, to me, have setups where they can actually take a move higher. I think what Mo said as well, there's people hiding. I mean, OKLO today, for example, is up 27%. Nothing's changed about the company outside of the fact that it broke over $100, and there's people who are covering short. So people are going to hide in the names where, like you said, the IWM, there's a lot of smaller caps that have, and mid caps that have a lot of shares outstanding that are heavily being shorted. And so those smaller companies are where people are going to kind of benefit and get yield. We've seen even names, I mean, just like, for example, Lyft this week broke out a little bit out of an accumulation phase. So Lyft is up to $22. So I think with the market riding at a high, it's good to just kind of sit back and balance. One, raise cash. I also think that there's going to be a rotation into Apple. Right, I know Apple's kind of been lagging behind a little bit.
We're going to get into Apple in a second, too.
My bad.
You good?
Yeah, so I have Apple with a breakout. This is the first time it's been able to hold over 240 in a good period over the past few months. So you see some level of rotation there. I think Apple's going to go to an all-time high and break over that 260. So that's it.
Moody?
You mind asking me the question one more time? I'm honest, man.
Okay, because it's actually kind of leading into, because it's pretty much your thoughts on the market right now, where we currently are.
Simple. We're gonna break all-time highs again. Even the all-time highs that we have now. Are we gonna get a correction? Yeah, I like that 100-point drop. I look at that as being like, a nice pullback. Not a big correction. However, I'll tell you this, you can invest anything that you want to from October 19th to November 19th. I've been doing that for, this will be my 5th year. I haven't missed at all. You can start selling some of your positions by January. I do agree with the protege that was speaking up here. Shout
out to Garage.
Yeah, shout out to you. You're seeing it pretty early right now. The video will continue to push on some steam, and it's just because of all the news and everything that's going on. However, when we come into the next year, into the first quarter, possibly the second quarter, you're going to see a turnaround in the market.
Oh, okay. Well, speaking of turnaround, all right, this segue. Hold on, we're gonna hold questions later. He kind of just snuck in there. So see what you did, Matt. You started a storm now. All right, but we won't forget about you. All right, so looking into 2026, because like I just mentioned, Fed is now starting to cut, and so. Because I'm not going to ask the typical questions like everybody else does, like what's your greatest loss, what's your greatest, nobody cares. Like, let's get to the nitty-gritty questions. Looking at 2026 and what we see, are you as traders, of course, a trader is looking at chops either way if the market goes up or down. But looking at it from the perspective of, since you guys also mentor a lot of traders out there, how are you feeling about the general, state of retail investors and retail traders today, you know, going into 2026, do you believe that essentially do you feel more confident for them, or do you feel more scared for them?
I feel like 2025 was kind of like 2020. People are very confident, and you can see that in their language. No one really talks about losses. Like, you go on social media, and that scares me because that's what happened in 2020. We got people that made money unopened, like how we made in GME in 2020. I don't know who remembers. And now they're teaching. That's probably their second or third trade. And I see like 50,000 likes, 2,000 comments. That scares me because people don't understand pullbacks. And if you have read a book called Psychology of Money, it talks about we only know what we see. So people that have only seen 1 or 2 years of data, they don't know what a pullback looks like. The problem here is if we go on Twitter today or X, people will make up stuff that's happened in hindsight. Oh, the market went up because this happened. The truth is we react, right, with whatever we have, and we're managing our risk. And that's how you have to think. At the start of this, I said I'm a professional loser. I only think about what will happen if I'm wrong. If I'm right, that's autopilot. I already know the next levels. But if I'm wrong, am I disciplined enough to get out? How many people here are having issues cutting on losses?
Sure.
Right? How many of you guys have ever gone in a trade not knowing what your predefined losses? Right? Imagine getting into a trade not knowing that you can actually lose. That's what a lot of 2025 traders are doing. They don't know they can actually lose money because that's not a potential possibility right now. So I feel bad for them, but I think people that stick through this will make it.
Okay.
But there is a pullback coming, and people don't like volatility as much as they think they do because most people are. Am I speaking too much?
No, keep going. They're laughing because of the fact is that they understand what you're saying.
Most people are indecisive. And when you scalp or day trade, you have to be extremely disciplined. I see Robinhood is telling you 0 days or back. We could do 24 hours of trading. It's beautiful, right? Wait till the market starts extreme volatility and WIX shoots up to 30, 35. And then people won't know what to hold, what to fold. And that's what I'm worried about.
Nice. Anybody else?
Yeah, I definitely scared for sure. And a couple reasons. Like, one, a lot of traders, their whole identity is I'm a trader. And like, you can do everything right in the market and still be wrong. You know what I mean? You can still lose money that's not guaranteed. And so I think, and I know you guys have seen it, like stories of people like losing everything and going into depressions, and like it's one of those things where like you have to set your expectations so it's not so shocking to the system when things don't go the way you expect them to go. The market gives you like the illusion that you're actually in control of things, but it's really out of our control. And like Mo said, the only thing we can do is control like our downside, like we can't control what we make, none of that. And so it's just keeping yourself grounded and understanding that, like I said, you can do everything right and it still not work out, and you can't make it your whole identity. Like, you still have to remember, like, this is something you're doing. It's not who you are. And like, losing money doesn't make you a horrible person. And it's hard to see. People really beat themselves up when they make mistakes in the market. And they don't realize that everybody goes through it. It's very isolating. But yeah, just you're not alone, and you got to remember to separate yourself from that sometimes.
Lawrence? Yes, sir. I kind of take the opposite view. I'm not nervous really for like a lot of my students and a lot of the people that I teach. The reason why I'm not is because I was actually, just funny enough, I was speaking about this a little bit earlier on my live. I feel like people are more educated now. And I think that there's an abundance of information. I think what Mo said was super right. As far as people posting on like Twitter or X and just posting like kind of just Instagram, wherever it is, just posting kind of outlandish things. But I think people have been able to really identify truly what's a lottery play versus what's real and deal nitty gritty to their strategy. So I'm not really nervous in that regard. I think that people are smartened up. I hear them on the 0 DTE. Everyone kind of knows from me, like I don't really trade options at all, like less than 30 days expo. And I find that a lot of people have really switched from maybe that mentality of trying to trade cheap. out of desperation versus being willing to kind of like buy time on contracts and go in the money. I also would say that to the point that Mo made on the last question, let's say the Nasdaq Nasdaq now can form 1,000 points. It used to be that way, but but you know, let's say the Dow is to fall 1,500, or the Nasdaq is to fall 500-600 points, which can happen next week. Let's say that actually does happen. You get the opportunity to really see who's over leveraged or who's not. Now, I want to go back to what Mo just said actually happened September 2nd. We were coming off of Labor Day. What we just discussed actually happened. The SPY was at 635 that day. Everyone's coming back from Labor Day, and the market was down. I told people the VIX shot to 20 very fast. So there was a lot of fear that came in. Like the VIX moving 25 to 30% in a day is not unusual in times of uncertainty. But you notice that the drops last less time. And I pointed to one, institutional investors can't sit in cash. They can't go to their investors and say, well, we were scared, so we sat in cash for 3 months. They're going to be saying, well, we're going to take our money elsewhere. We're getting the hell out of here, right? So they're not doing that. So to me, I think it's hard to imagine that, yes, there's going to be pullbacks, but smart investors, and unless something really spooks the market, is not going to pull back for long. The only time in the last 7 years that the market stayed down for an extended period of time was when there was some serious uncertainty. I mentioned to people that tariffs, this issue still not resolved. Well, where's their stock market at? It's at all-time highs. Back in April 7th, which was the low, everyone spooked. And the last thing that I'll say, the number one reason I don't think a lot of people are as spooked, because this, over the past 2 to 3 years, the access of being able not just to trade options, but almost on every major company that sits top 10 in the NASDAQ, you have some form of 2x leverage ETF. And so people look forward to trading leverage ETFs, whether it's a SOXO or a TQQQ, or if you know one of your favorite companies is AMD, you're going to hop in AMDL at $2 to $3. So you're going to hop in Tesla, TSLL at $6, $7. So that would be my last statement, is just, I think with the products that's out there and the education, people actually look forward to the market pulling back because of the tools at their disposal. Go ahead, Moody.
I take the same view as Lawrence. I'm not afraid for retail traders or the ones that are losing. Let them keep losing. I need you to lose so I can keep being a winner. I learn from them. Why? Because people's mistakes and stupidity, I look at it and I don't laugh, because I believe it was Farrakhan that said it. When you see a man falling, you don't laugh, you learn, right? And I trade very biblical, so I have no fear. And maybe in 2021 I was, because I was not educated in certain things. And people that I teach, they can speak just like me, because I pride myself in making sure that I marry my mind into yours.
All right, so let's talk about Apple real quick. So Apple just had a parabolic move today. I think that it's also led by some news that's coming out of the offices of JP Morgan. And as everybody knows, it's iPhone release day today. All right, so Lawrence, you're in the camp of saying that we're going to reach new highs for Apple.
Yep.
Go ahead.
Yeah, so Apple, the first go around, when they if you pull up the monthly time frame or the weekly time frame on Apple, you'll see that they made a move to hitting they tapped, like kind of like almost grazed the 4 trillion club. That was at the beginning actually in the beginning of December, right before the Fed didn't cut rates, and that's when DT was getting ready to get in, and we pulled back down. So just looking at this from a technical perspective, I think Apple's been a little bit undervalued. It's obviously had some love shown to it a little bit this year, but it defended that $200 level, and it's just really consolidated for the whole year. So if you know anything about Apple, obviously when it gets going, it gets going. It tends to just move the volume and goes high on it. So to me, this bull flag breakout on the weekly, I think it sets us up at least to get back to around 258, 260, and at least go test that all-time high. But if we don't break there, we'll form a double top and pull back down if we break over. then Apple will push up to the upside. Just as a quick note, Apple has lost some of its steam as far as asset allocation in the QQQ ETF. At one point, at its highest, it was around 12.5. Now it's been there between 8 to 9. Broadcom, ticker AVGO, has fought its way into the top 5. And then obviously NVIDIA took over the #1 spot. So go ahead, Mo.
One thing I want to mention is last year, if you wanted to buy any Apple product, you could have used Affirm, buy now, pay later, and they were not charging any interest. Today, if you want to buy anything on Apple, they're charging 8%.
Y'all understand what that means? Oh, okay.
Apple is not one company, it's 200 companies. They just added finance as part of it too. And most people, they won't look at a $4,000 laptop, they'll look at $50 payments. That's a problem. Not now, not for Apple, but I think it goes higher too.
Gotcha. I'll keep it simple. Apple's going to 315. I know that's going to break over 300, but it's going to 315. It's a little overextended on the 13-hour time frame. We're going to get a nice little pullback. However, Apple's going to break over 300.
Okay, so what does it require for Apple to reach 315? What are we going to require? Because I tend to believe that there's got to be some type of catalyst within the company that ultimately says, okay, hey, that gives investors the, hey, the coast is clear for us to go ahead and buy. We see something that's massive as it pertains to opportunity.
One, I'm just honest. You guys have way more fundamentals behind me. I'm a price action trader.
Okay.
Right. So everything that I'm seeing is actually on the chart, and I can break it down and show you why. So they are coming out with a lot of nice products right now, right? And is very innovative. One, I like the products that they're coming out with. I know that I'm personally gonna grab I think it was
You're gonna go Air or the Pro?
Say it again.
The Air or the Pro?
The Pro. I want the thing with the little wristband because I want to be able to, like, you know, talk to y'all or talk to anybody and, like, you know, keep texting or whatever the case may be. However, and I say that because I'm going to continue to text my wife, right? I could be on here and my wife texts me. I'm going to reply back to her. It may be disrespectful, yet that's my world, right? However, I'm not going to sit here and tell you all these fundamental things. I know people talk about, you know, the market cap and things of that nature. I'm literally looking at the charts and looking at the price action. And what that chart tells me is that we're breaking the 315.
Alaina, what you thinking over there?
I mean, I literally had an Apple in my name on Twitter for a really long time. I love Apple. I agree with these guys. I do think we go higher. The only thing I would add is that if you look at Apple as a company, to me, they're almost like a hedge fund. Like, they're not just out here blowing through money. They're sitting on cash. The stock isn't crazy volatile. It pulled back, but it's like digestible. So I think it's attractive. Again, like I said, I do think we see a recession at some point. And I think Apple is one of those stocks that, I know it's like, do you guys remember back when like all the AI stocks sold off and Apple was just hanging out?
Nope.
Like, they're kind of exempt from that bubble, you know? But I'm not mad at it. Like, I'm not mad at it. So yeah, I'm bullish on Apple, and I'm super happy and excited to see them recover.
Go ahead, Lauren.
Yeah, the last thing I just wanted to add, just a trend that I've seen, even though like Apple has kind of just shifted gears in the past year, where it's kind of taken a back seat to NVIDIA, and just some of the other AIs trades that you said. When you notice sometimes that the market is down, Apple is actually kind of pulling the switcheroo and being up. So it's kind of become that safe haven where people go and hide at, right? People will go hide in Apple when they feel as if the market is getting beat up a little bit. Because it just, you know, Apple's have the proven track record, the proven history. So that was it.
Okay. All right. So we're going to open it up to questions now.
Hey, Mark, can I add one more thing?
Oh, go ahead.
We have 11 days left into the new quarter on the 3-month chart. We're on a tweezer I said tweezers. No. We do have a tweezer. There's a nice hammer on there. However, it's a beautiful morning star. And this morning star's whole trajectory is to take out 250 and then 260. And that's all coming from the 3-month chart.
That's what you picked up, Lawrence? Or when you mentioned like going like around 258, 260?
Yeah.
Yeah. Did you still have your question? Okay.
So I know you're talking about like a pullback. You think it might be a pullback. So do you think it would be instead of like buying puts on like the SPQ? I mean, if it doesn't reach your number, you should make your money, but like a good hedge as well.
So the question was, so that way I'm correct, is running like, I mean, I'm assuming that you're saying Paul on S3. Oh, sell to open a put. Okay, on SQPQ, would that be a great hedge? And even if it doesn't reach your price point, is that still a good hedge?
I want to clarify one thing again. When we buy a hedge, we want it to go to zero. I just want you to know that. If you're trying to make money off of it, are you, so basically you're trying to sell a put? Is that, I'm not familiar with selling puts. I would never do that personally because I don't know.
Go ahead, Lawrence.
Yeah, I can cover the selling puts part. Like what you said, S triple Q, just so I'm correct. Yeah, so like the premiums don't really pay that much on the S triple Q.
Yeah.
So it's like minuscule, just depends. It could be like 10 cents, which should be $10. I would say if you're thinking about just on the hedge side more, what Mo was speaking about, specifically trading at the SPY or the QQQ would probably be better on a hedge day. Also as well, buying, I would be careful of buying shares of some of the triple leverage bearish ETFs because those instruments are designed to go down. So the longer that they stay on the market, and then when they drop usually below $10, they have to do what is called like a reverse split. So that's what you end up seeing. That's why you'll see on the side, like the stock was never 100 million or anything like that, but they've had to meet those requirements to stay listed on the market.
Okay, if you have questions, just come over here and we can form a line so that way we can get it done expeditiously possibly. So if you have a question, come on over here. Yep. It's like Price is Right. Come on down. How's it going, brother?
I just wanted to ask, could you elaborate more about the dates of October 19th and November 19th?
Yeah, absolutely. So those are my Santa rally dates, right? Most people get into the Santa rally like pretty late, like in December, and they hear the news talking about it. And I feel like that's extremely late to try to get into a Santa rally at that point. October 19th through November 19th, it's something that I've just been putting out in my group and something that I've been I've been investing, not trading, right? Investing and trading are two completely different things. However, I've been investing around those dates for coming in 5 years right now, and I have not missed not one time, right? And what I looked at it is like what Mo was speaking on, quadruple witching. Quadruple witching just happened. Most people think that quadruple witching is like a bearish thing. It's not that it's bearish, it's just a lot of contracts are about to expire right now. And Mo was speaking on people wanting to roll them in, right? Quadruple witching can be very bullish. You don't see the market? It's quadruple witching. We're breaking all-time highs, right? So to talk more about on those dates, it's more for the Santa rally. You can buy in between those two dates. I haven't bought anything after that date. I will swing, a 2 month or maybe 2 weeks, just because I want to make some extra money or something of that nature. However, it's the Santa rally dates.
Anybody else have any answers for that? Okay. Go ahead, Mom.
Yeah, just add this, that seasonality wise, September is usually a bearish month. And I think everyone posted a seasonality chart on September 1st. And usually what that happens is we get a rally like we did. And I'll be a little careful in October because sometimes that gets extended into October. One way, if you want to see if we get a buy the dip, is when the sell-off happens, is it quick or is it slow and controlled? Anytime the sell-off is slow and controlled, it stays. Anytime it's quick and bounces back, so we get a quick 100-point drop, I would personally buy the dip because then VIX comes off, people take profit. But if it's slow and controlled and they're killing premium on both sides, what I want to watch out for, that's when I would stay away from long calls.
Anybody else before we go into the next question?
Yeah, I would just agree with what Moody said. If you just pulled up the chart, you just look at the kind of that October 19th date. If you think about it, also coincides with earnings, right? So during that time, a lot of corporate earnings start to come out. So the middle of October, your second week of October is usually that's when the banks start reporting. They start getting ready to give you those Q3 numbers. So Q3 numbers are usually strong. And so then that was kind of what lifts you up going into that back half. So just keep your eyes on your favorite companies and your favorite tickers during that time. But that was it.
And I would just add real quick, if you want to be able to see that on the chart, just go to a monthly time frame or a 2-week time frame. And as well, shout out to Lawrence because I didn't know that. And I appreciate it. And that's why we're always here to learn from someone.
Dope. I have two quick questions. The first is, what does order flow tell you? Like, how do you use that? I think Moody mentioned that. So that's the first question. And then the second question, how do you tell institutional buy zones and institutional support on the chart? Just to make it count, because most of y'all mentioned that. I have no idea how to identify.
Absolutely. So this is what I specialize in. This is all I do. So when we're watching the flow, there's 3 things I look for. One, you're looking at the sense of urgency. Let's say they're buying calls. Are they buying calls 2027, 2028? That's when I'm not concerned. But if, let's say, CoreVeeve is an example, they bought about $5 million of calls in CoreVeeve for yesterday. So if CoreVeeve didn't move, they will lose about 4.9 million in money, right? Or less, depending on where they cut. The second thing I look for is repeat flow. Are they buying the same strike price, or if they're buying different? With CoreVeeve, they were buying different. So they're buying for today, they're buying for next week, they're buying for next month. Before I came here, they were buying 220 calls for March. CoreVeeve sitting at, I think, 120 right now. They're buying 220 calls. And so this is stuff I watch for. And then the third thing I watch for is frequency. Tesla, there's always flow. There's always call flow. Like, I think yesterday I had 290 million. I don't really pay attention unless it's very short term, which we saw, I think, about 25 million on November 500 calls came in. Now I'm paying attention. So these are the 3 things I watch. But over time, when you watch this, what you realize is certain names will get flow and they'll get beat, like MSDR, Tesla, NVIDIA. But then there's certain names that you've never heard of and they're getting massive flow, repeat flow, and short-term flow. And that's when I'll look at it. But that's not when I take the trade. That's when I add it to my watch list. From there, I'll add a risk reward on the chart. So exactly where will I get in? Where will I get out? Because I could be wrong. And how much money will I make if I'm right? And if the risk reward is not 1, 2, 3, I will not take the trade.
Yeah, I just Mo, what flow do you use? Just so people know. What's your recommended flow?
So I use Traditex, but honestly, you can use anything. Traditex, there's 2 kinds of flow. One is bot, it'll push. That will basically, they have something called golden sweep. So anything over 1 million will show up on the bot, but I'm also watching it live. And at the end of the day, I also get a report that shows what were the top 10 companies with the most flow. So I'll run a risk one on all of them.
Go. Did that answer your question? Institutional support on a chart. How do you see that? How do you spot institutional support on a chart?
So what I was talking about is demand and supply. One of the things is very clear to me is retail investors don't move the market, institutions do. So we were talking about Apple, and every time Apple went to 200, they would buy and they would keep buying, and they couldn't get rid of that 200. And if you just draw a support, let's say 200 breaks and it gets to 198, most people will exit. But I think Lawrence talked about looking at long-term time flow. So looking at daily and monthly chart. That's why I work with zones. I don't work at level, because if 200 broke, most people would get out. I would probably look at a level below that, and that will become that institutional demand for me.
So take a look at the S&P 500 because the market just closed. Get to your question. The S&P 500, I think it closed at 66,641.
Well, I'm looking at the spot. They closed at 663.
Good job. Good job. All right. Next question. And did you want to add something too, Lawrence?
Yeah, I just wanted to add for the brother. Charting and Technical Analysis by Fred McAllen. It's a book that you can get. If you turn your AirDrop on, I'll just AirDrop it to you. I have a PDF copy for you. So that's it.
Yep, Mark, I got something for him as well. You could, how you find support and resistance on your charts. I know I was speaking on price action, just the body of it, the opening and the close. You could go to any time frame, and I would suggest to go higher and then walk it down. All you have to do is, if you want a support level, look at your green candles, put a line right at the opening price of it, right? Walk up, put another line at the top of that candle, right? Not the wick, the closure of that body. That's going to be your support and resistance. Right now, if you're utilizing a higher time frame, like let's just say a 4-hour time frame, and you're utilizing that last candlestick for your support and resistance, I would tell you to use the previous one so that you know if we're going to break resistance or if we're going to come back down to the next support.
Yo, last question. My question to y'all is about risk management and how y'all operate on y'all stop loss when y'all in the trade. This should be it for everybody.
Okay, so I'm a little different. I'm a scalper, so I really don't believe in giving too much back for such a short amount of time to be there. Most of my trades are like less than 10 minutes. And so I have a really hard like 10% stop. Like I really don't like to give too much more than that. There is slippage, of course, but I think 10% is like a good target for a short-term trade.
Next.
So for swing trading, it's a little bit different. And I see people come up with numbers like, if I lose 20%, I'll cut. If I get 30, I'll make money. My only question is, where are you getting these numbers from if they have no relationship with the market, right? Because let's say you say my stop is 20, the market goes down 21% and bounces back. Now you're revenge trading. The biggest thing with the risk management, and Alaina covered that, is what you can control. Here's what you can control: your position size. The bigger your position, the more emotional you will be. That's the biggest thing. If you don't want to be emotional, figure out what your risk tolerance is and then size accordingly. If you feel like you're getting emotional, walk away. That's the best risk management. It's not staying behind the computer trying to look for another trade.
Go ahead, Lawrence. I know you.
Let's go. So I was just gonna say it's really per trade type for me. I agree with Alaina. Like when it comes to day trades, 2 to 7%. Like a short-term swing, I consider a short-term swing to be anything less than 5 days, about 10 to 15. And then midterm swings can be anywhere between any longer than 5 days up to 2 to 6 months. Then I'll say like 20 to 25%. And then leap options are usually like 30 to 35%. Adjustable though, like, so that's like the percentage base from my entry, my fill, let's just, we use an example of I get filled for a contract of $2,000, right? So you take 20% of that and that would be my stop. The reason why I say it can be adjustable, depending on kind of to touch on what Moody said in the beginning of our conversation, when you enter the trade, you could have been in the right trade, just really literally got in at the wrong time, right? So I adjusted in that way and analyzed, one, does my thesis still hit? Is it still intact? And then use those stops to take me out of the positions. And then the last thing that I would really just add outside of per trade type is just, to me, it's about sizing, knowing your size, right? So whether you're trading with 5,000, 50,000, 100,000, it really comes down to sizing. So how many contracts are you trading? I think sometimes people can get a little bit over leveraged size-wise, and those the over trading piece. I think risk management is also about knowing when not to trade. I think it's so important to know when to trade, but a lot of people don't talk about, hey, if you know that the Federal Reserve is going to be speaking, maybe Monday and Tuesday is probably a day you should take off because the volume is going to be low. So when the volume is low, I look for, like if you use simply Yahoo Finance. Yahoo Finance will give you the average 3-month volume on a ticker, any ticker that you look at. If I notice that I'm an East Coast person, so if I know that it's 11:30 and a stock usually trades 60 million shares in a day, and it's only traded 5, I'm not going to be looking to trade that ticker. It's just low and volume. So I think trading names that have high volume or fair volume also help, because if there's no volume, especially when you're talking about options, you need some sort of movement that could actually come in and happen. So that would be my full answer.
Go ahead, Moody.
So I'll give you my beginner answer and my answer for right now. When I first started trading, I had like a percentage. My percentage was not 20, 10%. It was dollar amounts. $300 to $500 would keep the 9 to 5 away because I wanted to retire my job. That's all I wanted to do, right? So what I would tell you to do is utilize liquidity. Why? Know your chart, know your time frame. Me at this point now, I don't have a percentage. I could be down 30%, does not mean that I'm going to cut that trade. The chart's going to tell me if I need to cut that trade. And 9 times out of 10, the bottom liquidity is the same thing as an entry point, right? Liquidity is the wick at the bottom of or the top of a candlestick, right? So let's just say I'm in calls and I want the market to go up and it starts coming down and it's heading to, I'm on a 5-minute time frame or whatever time frame that you can imagine right now, right? Let's say it's going down to the bottom of that wick. I'm not just going to add soon as it hit that. But 9 times out of 10, that's where everybody stops at. How do I know that? Because I used to put my stop there and I'll start the revenge trade where it's like, boom, it starts to pop up and I'm like, wait, hold on. What the heck? And then I'll get back into the trade and it'll give a little bit of profit, then it'll reverse back down, right? So exactly, right? So what I would tell you is learn your previous candlestick, right? We're always trading the previous candlestick. I don't care what time frame it is, and up to the 50% of that candlestick. It is either going to reject that 50% of that candlestick and start to go down. What you need to just look for, is it going to break the body of the previous candlestick? And if it does and hold under that body, 9 times out of 10 is going to go for that liquidity, which is the previous wick.
Go ahead.
So one thing I think is super important is, well, for one, like our brains, we're basically wired to put more emphasis on like the here and now than like the future. And so like, even if you're building a small account, and I hear this all the time, they're like, oh, it was just a $10 contract or $20 contract. It still matters, you know, like you have to build these habits and build these patterns of thinking from the ground up. Like it's not, I'm going to, you know, have a 6-figure account and then I'm going to start protecting every dollar. Like it has to be from square one. So with your risk management, a lot of times, if you're willing to lose more money than you actually have to lose, it can do a lot more damage than good for your long term. You know what I mean? Like it can cost you way more than $10 or $20 down the road to make that decision in the here and now. Does that make sense?
It does.
Like it just gets really, really expensive. That way of thinking can compound.
So what we're saying is bad habits can be expensive, especially if we do not become more disciplined.
Yeah. Like if you can make, let's say you can make $100 a week, right? And that's very, very baseline. And let's just say like you've blown up something and now you can't trade for 6 months, or now you're snowballing losses and revenge trading. Like that's what I mean by those losses can compound mentally and financially.
Yeah. So y'all, you are officially off the hot seat. I urge each and every single one of you in this room, if you do not know any of these traders, get to know them, come up and talk to them. You know, we didn't bring them up on the stage for no reason. We brought them up on the stage because of their insights are invaluable, as you can see here. So thank you to each and every single one of you for joining us on this panel. I know that it's getting to lunch hour because I'm looking at some of these faces and I heard somebody's stomach gurgle while I was over there. So, and you know how we get when people get hungry. So we're gonna take a break. We will reconvene at 2 o'clock. But thank you, Mo. Thank you, Alaina. Thank you, Lawrence. Thank you, Moody. I appreciate y'all. And I hope to see more things to come from each and every single one of y'all in the very near future. Thank y'all. Give them a round of applause, everybody.
I'm always seeing them, DJ Hagen, give them the dumb play. Hagen leads on decks inside. Hagen DJ on decks inside. Come again, Hagen leads on decks inside. Shut down, don't with this one. Come again, Hagen on decks inside. Hagen DJ on decks inside. Come again, Hagen DJ on decks inside. Shut down, don't with this one. Again, Hagen, this one is on. Hagen, one is on. Hagen, this one is on. Shut down the dogs with this one. Come again, Hagen, this one is on. Hagen, this one is on. Hagen, this one is on. Drop down the dog with this one. I'll come again. I'm always seeing them. DJ Hagen, give them the dub play. I'm always seeing them. DJ Hagen, give them the dub play. I'm always seeing them. DJ Hagen, give them the dub play. I'm always seeing them. DJ Hagen, give them the dub play. I'm always seeing them. DJ Hagen, give them the dub play. I'm always seeing them. DJ Hagen, give them the dub play. We sing them. DJ Hagen, give them the dub play. always sing them. DJ Hagen, give them the dub play. Hagen DJ on decks inside. Hagen DJ on decks inside. Come again, Hagen DJ on decks inside. Shut down, down with this one. Okay, Hagen DJ on decks inside. Hagen DJ on decks inside. Come again, Hagen DJ on decks inside. Shut down with this one. Again, Hagen, this one is on. Hagen, this one is on. Hagen, this one is on. Shut down the dog with this one. And come again, Hagen, this one is on. Hagen, this one is on. Hagen, this one is on. Shut down the dog with this one. And come again. Always sing them. DJ Hagen, give them the dog play. Always sing them. Give them the dog play. Always sing them. DJ Hagen, give them the dog play. Always sing them. DJ Hagen, give them the dog play. Always sing them. DJ Hagen, give them the dog play. Always sing them. DJ Hagen, give them the dog play. Always sing them. DJ Hagen, give them the dog play. Always sing them. DJ Hagen, give them. Next six next slide. Okay. Next slide. Next slide. Next slide.